SPX 500, for example, we can go to a different market. For example, let's say we go to AUD JPY, right? For example, right? This is a real market that I'm actually interested in trading, and we're just going to go to a different server so we don't have a bunch of stuff in our way. We're going to start off on the weekly time frame. Top-down analysis is meant to literally start from the top down. So remember, we don't want to be looking at the market way too back to the point where we can't even look at the market structure, where you can't even see the candlesticks. And remember, you don't want to be super zoomed in to the point where you can only see the last 5 candlesticks and you can't look much to the left. You want to get a healthy amount. For you to do a proper top-down analysis on the weekly time frame, you should go backwards, max anywhere from 5 to 6 years. 5 to 6 years should be the max. You go backwards to identify structure if something is bullish or bearish. So go 5-6 years back to identify the market structure. Now, I know this might seem like a lot. You're like, Alex, that's a long time. That's a lot of market structure. But you really only need to do this one time. And you only need to do this one time because once you understand where the market is and where it's bullish or bearish from, you really don't ever have to go back. So like, let's say right now we go back 5-6 years, and that's the max, right? Because we don't really have to go all the way to this point right here, because we can very clearly tell this has shifted to the upside and then we've gone bullish or bearish. But let's say if we were to go through all of this market structure right now, it would probably take us 10 minutes, 15 minutes. And now here you can focus on the higher time frame stuff. When you go down to the 4 hour, there you're going to get access to the 4 hour higher low, lower high and lower low. Just a little bit of a tricky secret trick that I have sometimes when there's too many things in front of the support at this point, at resistance at this point, at support at this point, and at resistance at this point. This right support level right now, where the market has abundance, you want quality over quantity when it comes to identify these areas of interest. So an area of interest is identified on something that has a minimum of 3 touches. An area of interest is good to buy or sell whether you are above it or below it, as long as we have 3 touches. The more touches, the better. And an area of interest is needed because you need to enter a trade at an area of interest. You cannot enter a trade if it's not at the area of interest. And you can only find an area of interest inside of the higher high and higher low, or the lower high and the lower low. At no other point can you find the area of interest elsewhere. If you put an area of interest up here, it's pretty much bullshit, because dude, we're like the market hasn't even gotten there. And if we're looking to buy, we can't buy at a fucking resistance. Like, how does that make sense? You're basically betting that you're going to break through a resistance, and that's not logical. You want to buy at a support level. You want price to be at a support level and then it push itself off of it. That is simply the logic when it comes to trading. So when you buy, you need to buy at a support level. When you sell, you need to sell at a resistance level. So you buy at support and then you sell at resistance. At no point do you break this rule right here. This is probably the simplest thing that I can write in this whole entire class, and it will probably be the most valuable. I cannot stress to you guys how many of you guys are buying at resistance or selling at support. Like, how does that make sense? If the market is going down, right? And the market is going down and you are literally at a support level right now where the market has reacted to it 3 times from this level, why are you selling into this level where literally historically what it does from here is have a reaction? Why are you buying from this level? Some people just don't have, they don't know what to say. Some people just don't have an answer. They're like, oh, I don't know. Well, no shit, you didn't know, because you wouldn't be doing that. This is like jumping into a 2-foot pool. Why the fuck would you do that? Like, you're gonna literally smash your face. Is there a 1 in 1,000 possibility that, you know, you happen to break through the pool and break the concrete and then go through the foundation? Yeah, if you're Superman or some shit. But the odds of that happening are very rare. Can it happen in trading? Yes, of course. But I'm talking about in real life, right? You would never jump into a 2-foot pool. So you would never sell into a support level. You sell at a resistance level. Once price is at an area where it has had more than 3 touches, this right here is a valid resistance level. You sell from a resistance to a support. You buy at a support into a resistance. At no point do you flip those tables around. If the opportunity is not there, you simply don't do it. Let's say you really want to take the trade at this resistance level right here. Please, by all means, but you need to be above it. Price cannot be below it. You need to be above it. You need to be above this area for you to really buy at this area. But if you're below it, what confirmation do you have that it's actually going to react from it if it's yet to do it to the past? It's never done it, so why would it do it now? So when it comes to area of interest placements, I need you guys to understand that you are placing in between this higher high and this higher low. And our job as traders, literally our only job, is to wait for this retracement. So we know that this is bullish. Our job is to wait for this retracement to happen. And this retracement can literally happen anywhere, right? This can happen here and have the push up, here and have the push up, here and have the push up. This retracement can literally happen anywhere in the chart. Now we have a higher probability of it having a reaction from here than from here. Why? Simply because if you look to the left, this area has only been respected one time, and this area here has been respected 4 times, 5 times. So if the market makes it to this area, the odds of it reacting are going to be a lot higher than this one. Can the market still have a reaction from this level? Of course, and it will. And then you won't be able to enter this trade here. But with a proper strategy and trading with a plan, you need to take the trade where it simply makes sense. And it will always make more sense to take the trade here than to take the trade here. So trading with areas of interest or support and resistance is literally getting you to be able to pretty much predict precisely where this retracement has the highest probability to stop. Once it stops at this area, then you start to apply extra confirmations and then see if you're interested in entering the trade. This retracement is going to be a key fundamental to your success in trading. Whether you are patient enough for this retracement to happen or not, that is entirely up to you. I can't teach patience. I can teach you what you need to know in order for you to apply patience, but patience is what's going to either make or break you as a trader when it comes to applying any type of strategy. So back to areas of interest. Areas of interest are placed in between the structure points. There is a never-ending amount of areas of interest, right? If I were just to, let's just say, just for examples purposes, I'd bring this structure level up here and I'd bring this structure level up here, just for examples purposes. This right here would also be another area of interest. Why? Because we have 1, 2, and then 3. So this right here is a valid area of interest. Now price is going to have a retracement. On this retracement, we can potentially have a push up, or we can make it to this area and potentially have a push up. That is it. Our job as traders is to wait for the market to make it into this area. And when the market makes it into this area, we apply our strategy to enter the trade. That is it. You only buy at this support. Now, let's say the market just keeps going into this area, keeps having a push down, and from here, it just does something like this. It breaks below the area of interest. Do you still buy it? No, because we did not respect the area of interest, because this market can now use this as resistance. What did I just say in this example over here? This example, you cannot buy at a resistance. So yes, even though we've had the retracements and we've broken below price, technically right now we are below this resistance, exactly how we've been here, exactly how we've been here, and exactly how we've been here. So this is destined to literally create a move like this. Can there obviously be the event where it from here does this? Of course, and that will happen, and that is inevitable. But in order for you to enter this trade, you want to wait for it to actually break above this area and then use it as support. You need for it to actually come back and retest it as support, how it has done here and how it has done here. You need to use it when price is above it, not when price is below it. Once price is broken above it and it comes back into it, that is when you use it. Could you use it right as soon as it breaks above it? Sure. But I'm going to be teaching you guys on how to have the extra confirmations to actually use it when it comes back into it and uses it as support. I'll explain all that later when we get to the entries and how to actually start applying a strategy. Right now, I'm just teaching you what areas of interest is, what is support and resistance. Like, this is all very basic standard stuff. I haven't even taught you guys anything of a strategy yet. The only thing that I did teach you is how to properly place this area of interest. So many of these traders just place these areas of interest randomly in front of the market, and they just place it anywhere. They're literally just putting zones throughout the whole entire chart and calling everything a supply and demand zone, an area of interest, so you could just pretty much get bombarded by this information and you buy into their bullshit, because they make it seem like you need them. They're trying to manipulate you so they can get you to make them feel like they have this better understanding of the market and that you need to learn from them and you need to follow them and you don't have to do none of that shit. Having an area of interest only makes sense to have it within the higher high and the higher low. Very fucking simple. So can it break below it and can it still have a reaction and move to the upside? Sure. Now, this is where I would use this support level. If it breaks below it, I would not be buying below it. I would only be using it if we break and retest above it. But for this example, let's just say that we did something like this. Sure. Let's say we actually had to move and we had to push to the upside. Cool. Our area of interest is validated. And guess what? What happens now? Well, we have a new higher high. And where's the higher low? I don't know. Get the head of the snake, start working our way back, make the first turn. And now that right there is going to now be the higher low. All right, cool. If that's the higher low, we got to start cooking again. We got to start finding the next potential area of interest where this market is going to now have a reaction from. So the way we find an area of interest properly, right, is by getting this box at the top of the zone. And our job as traders is to start working our way down all the way to that higher low and find points where the market could potentially have a reaction from. So we start working our way down, working our way down. Boom, we run into the first resistance. Is this a potential valid area of interest? No, because it only has one touch. Cool. We keep working our way down, keep working our way down. Boom. We run into a second spot. Well, you know what? This is actually pretty close to this spot, and it's pretty close to this spot. Let's see if we can get a very tight, small zone. Sure. Here we have 1, 2, and 3. 3 touches makes a valid area of interest. So this is the first potential area of where the market could have a retracement to then have a reaction to the upside. That's just the first potential area. Right now, we have absolutely no idea from where else. Bring out our trusty box. So we already understand this is area of interest 1. Let's keep working our way down. We can, boom, we run into this structure point right here. Can we add another structure point right here? Sure. We have 1, 2. Is that a valid area of interest? No. Can we make a big zone like this and we get 1, 2, 3, 4? Sure. But the zones have a maximum and minimum sizing of these zones. And I'm going to get to the sizing of these zones once we actually get to the charts. But the max a zone could be is going to be it's going to be 60 pips. Max a zone could be is 60 pips. Anything bigger than 60 pips, it will no longer be a valid area of interest. So the max a area of interest could be is 60 pips. So we're going to add this as another side note over here. Alex, how do you measure the pips? I already taught you this. You use this tool over here to the left-hand side. Start from the bottom, work your way up to the top. And what do you have here? This zone is now going to be 70 pips, making this too big of a zone. The biggest an area of interest could be is a total of 60 pips. This zone right here is 70 pips, making it no longer valid. We start off from this zone to right here. You can tell this is 28 pips. That is perfect. That is half of the maximum a zone could be. Now, could you have something smaller? Yes, I'd say the smallest a zone could be. So the max it could be is 60, and then the minimum it could be is 5 pips. You'd never really go that small, but just in case if you do, for people that ask that question, a minimum of 5 pips. So this zone right here, as you can tell, it cannot be used as a valid area of interest. One, because this one right here doesn't have a minimum of 3 touches, and then that one right there is more than 60 pips, right? So we start working our way down, working our way down, working our way down, and boom. What do we run into? 1, 2, and then 3. What do we have here? A valid area of interest. Now we can make this one very tight. As you can tell, this one respects it very, very, very strong. So we can make this one 5 pips like this, or we can make it the actual max length, which right here would be 62 pips. Let's just call it 60 pips for this example's purposes, for us to then have a 4th structure point. Could we do that? Sure. But personally, myself, I would much rather have this zone be as tight as it possibly could be. I wouldn't want to stretch it out to have more touches. I would rather make it just be tight. The tighter, the better, and the more respected it's going to be. So here we have 1, 2, 3, and 4. That right there is a valid area of interest. Now, I know a lot of people in the past have asked me when I do classes and when I educate people, can we consider the actual higher low a area of interest? Of course. If the higher low happens to have 3 touches, sure. So for example's purposes, this one has 1, none, and none. And no, we cannot go below the higher low to add touches to the area of interest, because if we go below the higher low, guess what happens? We are then bearish, making this no longer a valid area of interest. So now this market right here, we've just done the top-down analysis. We've determined that this market is bullish. And now we've found 2 areas of interest. This right here is going to be daily area of interest number 1. And then this right here is going to be daily area of interest number 2. So these are 2 areas of interest where the market could have a retracement into this level. And after having the retracement into this level, it could potentially have a reaction. Now, again, the big important thing is potentially. One of these areas of interest could do it, or none of them. This area of interest right here, area of interest number 1, is not stronger than area of interest number 2. Area of interest number 2 is not stronger than area of interest number 1. Quote unquote, obviously, if it has more touches, it's supposed to be stronger. But that doesn't mean that I would prefer to enter the trade at area of interest number 2 rather than area of interest number 1. They're both equally as much respected to me personally. And the only time I take into account how many touches is inside of the area of interest is when it comes to the entry signal. And I'll be explaining that later inside of the actual entry signal area. But for right now, to make a valid area of interest and to wait for the market to have a retracement, this is all I need. I need my areas of interest, and area of interest 1 is equally as strong as area of interest 2. I would never pick one over the other, even if this one has 100 touches and this one only has 3. The market could have the reaction from both or from none. The market can simply have a reaction to right here in the middle and then have a push to the upside. And a lot of students ask me all the time, they're like, Alex, what happens if the market does that? What happens if it actually has a retracement either in the middle and it doesn't hit any of your areas of interest, or right above your area of interest and it never hits it and then it has to move to the upside? What do you do then? The answer is nothing. You don't do shit. That wasn't your trade. That never met your strategy. You move on to the next fucking pair. Why are you trying to figure out to make something work when you already have something that works? You just have to wait for it to happen. Why are you trying to make everything work when all you have to do is wait for one thing to work? Don't try and catch every move. I don't try and catch every move. You know how many moves I miss a week and I still predict the overall trend, but they never come to my zone, so I never take the trade. I just say 2 to 3 moves every single week. Hundreds of pips, hundreds of thousands of dollars. But I also avoid hundreds of pips, and I also avoid losing hundreds of thousands of dollars by sticking to my plan. It's never worth breaking my plan just to try and catch a move and prove a point because I know how to trade or I know how to identify the trend. Waiting for the trade to these areas of interest is going to be the key thing. So now let's say, for example, this market actually does this, right? This market has a push to the upside. This is the higher low. This is the new higher high. Oh, make this a new higher high. This will be the higher low. Obviously, this area of interest is no longer valid because if price gets to there, we will then be bearish. And this area of interest is no longer valid. Now, on the daily time frame, if I were just to place this area of interest, start working our way down, boom, we run into this structure level here. And then guess what? That's it. There's no 3 touches here. There is no 3 touches here. There's barely 2 touches here. Can there be a scenario where there is no area of interest? Of course, this is 100% a possibility. Does it happen? Very rarely does it happen. But if it does, there's just simply no area of interest. You just simply go down to the next time frame or go up to the next time frame and wait for an area of interest at that point. Right now, I'm just teaching you what an area of interest is and how you can identify it. There's 110 million different what if possibilities, and one of them is this. And if that happens, well, then that happens. Now, let's say this market, for example, just does this. All right, cool. Now what? We're bearish. This is the lower low. Where's the lower high? Right up at this point right here. If this is the lower high and this is the lower low, guess what? We're now going to get our area of interest in between like this. And then we're going to do the exact same thing, just now working our way up, because our job is to predict this pullback, and on this pullback for us to then potentially take this out. Now, where does this pullback stop? Well, it's the same thing. We start working our way up. Boom. We run into this area right here. We have 1, 2, and nothing else. Oh, I lied. We look a little bit more left and bang. Cool. Let's call it right there. We have 1, 2, and 3. That right there, ladies and gentlemen, is a valid area of interest. That right there is indeed considered an area of interest. Area of interest number 1. 1, 2, and 3. Cool. We have the first area of interest. We just simply go ahead and start from this point right here and keep going back. We have 1, none, none, and none. No area of interest. We keep working our way up. Boom. We run into this right here. 1, 2, and 3. So we already had this area of interest in the past. Very clean, very obvious. We keep working from this point right here. We keep working our way up. Beep, 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 beep. Boom. Guess what we run into here? 1, 2, and 3. And I'm sure we can squeeze this one in here for 4. 1, 2, 3, 4. And then if we keep working our way from the top, from this right here, keep working our way from all the way right here, we run into that point. There's only one structure point there, and then there is another one like this. How many pips is this? This is a total of 52 pips. So technically on this lower low leg, there is 1, 2, 3, and 4 areas of interest that the market can potentially have a reaction from. The market can have a pullback to either here and have a reaction, here and have a reaction, here and have a reaction, or here and have a reaction. Once again, is this something that can often happen, that you would have 4 areas of interest? Yes. But our job as traders is just to wait for the market to get to every single one of these, or whichever one of these it gets to, and then us apply the strategy to it. I can say based off of my experience that if I were to have 4 areas of interest, my strategy would probably have a full check off checklist at maybe 1 or 2 of these areas of interest. Now, not because the area of interest isn't valid, it's just because the market isn't going to react to every single one of these. It's probably going to break right through this one, and then maybe here it'll have a little bit of a reaction, but then I don't get the proper entry signal that I need, and then it'll actually make it to this area right here, and then here's where I then get my entry signal, and then I actually take the trade. If I miss this trade at this area, can then I enter the trade if it breaks below this area of interest to then sell? Sure, yes, you can do this. These are all different possible potential scenarios and hypotheticals of things that can happen. But our job is to wait for this retracement. So once we get this, we can then sell. So this is just a very simple example of a sell market. Same exact thing. This is now the new lower low, for example. This is now the new lower high. We could invalidate this area of interest. We could invalidate this area of interest. This area of interest could stay because it's still within the lower high and the lower low. We just do the exact same thing. We start working from the bottom right into this point right here. We can find 1, 2, 3, and let's just call this one 4. Don't worry, I do this very fast because I think I've been doing this for longer than I can remember. But here we have 1, 2, 3 with this point right here, 4, 5, and 6. So let's just say we have 2 areas of interest in this market. Same exact thing. We're waiting for a pullback into here to then sell, or a pullback here into then sell. That right there, ladies and gentlemen, is how area of interest works, how you can spot it in the middle of the market, and how you use it with market structure. Now, We go do this in the real market, in real time. It is no different, ladies and gentlemen. If we come here to the weekly time frame, we can only place a weekly area of interest within this higher high and within this higher low. Now, same exact principle applies as to the trend. For you to identify the area of interest is going to be the exact same thing. So here we're going to do weekly and area of interest, daily and area of interest. 4 hour, there's going to be no area of interest. So we only look for an area of interest on the weekly and on the daily. But we use these 3 time frames to identify the trend, but we only find an area of interest on the weekly and the daily. Now, some of you guys may be asking, why are we going to only find an area of interest on the weekly and the daily? Well, the truth is that the market is going to be respected so much more from the higher time frames compared to the lower time frames. In the 4 hour time frame, I have found that I can have 10 areas of interest. And I don't want 10 areas of interest. I want maybe 1, maybe 2, max 3. I don't want more than 3 areas where the market could potentially have a reaction from. And I always want to trade with the higher time frames. Not because I'm a swing trader. I don't want you guys to get that confused. It's because I like to trade with the higher time frames backing my trade. I want the weekly and the daily trend to be in my favor so it can push my trade in that direction. I want to buy or sell the market at a daily or weekly area of interest so that support level is being pushed by the higher time frame. I want to buy at a daily support because that's what's going to give me that daily push to the upside. I don't want to do it off of a 4 hour. A 4 hour area of interest could break and retest it 10 times within the same day. On the daily, it'll take much longer just simply because the candlesticks take much more to move, so they get respected a lot more. So in order for me to find an area of interest on the weekly, I have to go back max 5 to 6 years, the exact same time it takes me to identify the trend. And I only have an area of interest in between the weekly and the daily. No area of interest on the 4 hour. So if I were to get this area of interest and I were just to drag it left, I don't really have to go further back than, let's say, 2 years. But for example, right now in the weekly time frame, we understand that that is the weekly higher high, that is the weekly higher low. And what we could start doing is working our way down. If we start working our way down, what do we run into if we don't have a clear vision? We can go to the market structure. And on the market structure, what do we have, for example, right here? We have 1, 2, and 3. Can that be a valid area of interest? Sure. Can we make this a very tight area of interest like this? We have 1. We have to include this one right here for it to be a valid one. 1, 2, and 3. Technically 4 if we include this as well. So we can probably move it up just a little bit. And nothing else to the right. Now let's see how that looks like on the daily with the candlesticks. Very clean on the daily. Very clean elbow here. Very clean elbow here. And very clean elbow here. This one is not so clean on the candlestick chart, but we still indeed have 3 very valid elbows, including the candlesticks. So maybe on the line chart, you can have 10 structure points, but when you go verify this on the actual candlestick chart, you maybe only have 5. So you always want to use the line chart to make it an obvious area of interest. After you make it an obvious area of interest, right? So we would also have counted this right here. So that's an obvious elbow rejection from this area of interest. We then go to the daily to confirm that it's a real rejection or a valid elbow. And then there we would actually remove it and be like, okay, it's not as clean, for example, as this one or this one or this one. These are more obvious reversal points. So even then, this is still a valid area of interest. So this right here would be a weekly area of interest. We keep going from this point down right here and keep working our way down. So we go back to the line chart, switch to the line chart, and on this line chart, we're going to now identify the next potential area of interest. Start working our way down, and boom, we run into this right here. We have 1, 2, 3, 4, 5 rejections from this area. All right, cool. Can make this a very tight zone. Also, by the way, we have to measure this zone. I forgot it. So we measure this zone. We have a total of 54 pips. So yes, this is a valid area of interest as long as it's below 60. Cool. This area right here, we have 1, we have 2, we have 3, we have 4, 5, and then 6. Let's go check out the candlesticks to confirm that that shit is legit. This one's okay. So we have 1. This one's okay. We have 2 for sure. 3, 4, and 5 for sure. Okay, so we can technically remove this one. I like this elbow. I like this elbow. I like this. I like this. And I like this. Very clean break. Retest, sell. Rejection, sell. Cool. So that's area of interest 2. Not bad. So we have a weekly second area of interest. Next, we're going to continue going down. We're going to go all the way until we make it to the higher low. We stop at the higher low every single time, or we stop at the lower high if we're looking for sales, right? So now we continue going to the downside, and we then run into, boom, this structure point right here. We have 1, 2, 3, 4, and 5. All right, cool. Right here, we also have 1, 2, 3, 4, and 5. So if we were to once again get our trusty circle and do this right here, and I've never seen anybody do this how I'm walking with it like you guys right now. Everybody tries just to speed through this stuff. Like, I really want to genuinely take my time so you guys can learn from this, because I'm telling you, I searched the internet for fucking months to understand this. Like, you guys have no idea. We go back to the candlestick chart. This is a clear rejection. This is a clear rejection. Very clear, very clear. And not so clear. I would not count that as a structure point. I would count this one. I would count this one. Yes and yes. Even then, that is more than 3. That makes that a valid area of interest. Now, this right here technically are the 3 weekly areas of interest. This is weekly area of interest number 1, weekly area of interest number 2, and weekly area of interest number 3. That right there, as you can tell, ladies and gentlemen, is a very clear indication that these are the potential areas where the weekly time frame could have a retracement to buy, and then retracement to buy. Now, what we would do is we would go down to then the daily time frame, right? And on the daily time frame, we're going to do the exact same thing, but for the daily higher low and for the daily higher high. So we're going to have this blue on blue box be the weekly area of interest, and this blue on blue box be the weekly area of interest. This is also the weekly area of interest, but for the daily area of interest, we're going to have a red outline, right? So we're going to get this box right here, and we're going to make the outline of this box, we're going to make it red. So we can start off once again at the high of this market, and we can just basically start working our way down. We're basically going to run into this structure area right here, resistance, support, and we can look more left. We're going to see more structure points coming up to the left hand side over here in just a second. We're going to see more structure points, and the goal for us to do here is just to try and minimize as much noise as possible and focus on as many things as just focus on like the clear market structure points. And right here, as you can tell, we can have here 1 structure point up here, 2, go a little bit more to the left, and then we can also focus on 1, 2, 3, 4, 5, 6, 7, right? So we have more than 3 for sure. Let's look at it on the candlestick chart. So right here, as you can tell, we have 1, 2, 3, 4, 5, 6, 7, 8, 9. At that point right there, we got 10. So obviously there is also a valid daily area of interest right in here. Now, you can tell, what a coincidence that that daily area of interest also happens to be the weekly area of interest, right? So just putting that on to the side, and that's going to be important later on. All right, but for now, let's keep going, right? Let's focus on from this high point up here, working our way down from this point right here, and then boom, we run into this next structure points that we have right here. Obviously, for just the simplicity of the video, I've skipped this structure point and I've gone to the more obvious one. Can there be more structure points at this area right here that I have just identified over here, and I go more to the left? Sure. I'm sure we can find some structure points there. You can find 3 touches anywhere, but our goal is to find the 3 closest touches to where price is right now and the most relevant. If you have to go back far left, you could, no problem, but you want to get the most strongest and most relevant points. Now, if you notice right here on the daily time frame, what do we have right here? Well, 1, 2, 3, 4, 5. How does this look like on the candlestick chart? Perfect. 1, 2, 3, 4, 5. We have another area of interest, and what a coincidence, we can also align that with our daily higher low. Well, would you look at that? We have weekly area of interest number 2 happens to also line up with our daily area of interest number 2. So now this right here is pretty much a perfect coincidence, right? I wish I would have known this before I even started this analysis. It would have been easier if it wasn't, but it would have been easier because I could have separated the areas of interest and stuff like that. But this right here shows you how areas of interest from the weekly and the daily happen to align for this example right here. We're going to go through all those examples where they don't. So for now, we're just going to remove this weekly area of interest, the third one, because there's so much that price has to come back through and actually be able to break before getting there. So now we go back to the weekly time frame. This is what it looks like. This weekly area of interest happens to also be a daily area of interest. This weekly area of interest happens to also be this daily area of interest. So what do I like to do in a scenario like this when we have two overlapping areas of interest? What I like to do is to combine them as much as I can. I like to find the happy medium. I try and see if I can make this area of interest right here on the daily somewhat fit in the middle of this weekly area of interest. And if it could still have more than 3 touches to fit inside of this area of interest, then I would just minimize throughout the top. So as you can tell here, I moved it down a little bit and I have more taps here, more taps here, more taps here, more taps here. And what I try and do is just make this as tight as possible. So 60 pips is the biggest, but the sweet spot is around 20 to 35 pips. Now this daily area of interest is right at that 25 pip mark. And I'm sure that I can squeeze this weekly area of interest to this structure point and then squeeze it right into that daily structure point as well. So if we go out to the weekly, let's see if we have a minimum of 3 touches with that right there. As you can tell, indeed, we somewhat still do. I would have to move the weekly a little bit higher for us to actually get that right there, for us to get that right there, and then in order for us to also count that structure point right there. So right there, we are counting that structure point and that structure point. What I could do here as well is move the daily time frame up along with that weekly. And then boom, right there we have a perfect daily area of interest that aligns with a weekly area of interest. This is a beautiful sweet spot. This right here lets me know that if price retraces to this area, which is where we are right now, not only are we at a daily and weekly area of interest, but they're both overlapping. And if it just doesn't get respected here, then it has a higher probability of coming to this area and then basically respecting and having a reaction from that point right there. This right here is beautiful. I love to see this. I love having both of these confirmations because this just lets me know that these time frames are actually in sync. The weekly and daily are in sync. Areas of interest in sync. All overall, it makes sense to actually enter this trade as a buy rather than a sell, because at the end of the day, that's all we're trying to do. We're trying to make this trade make more sense, that it's going to go to the upside and to the downside. So right now, this is very, very, very simple over the top down analysis. Now, again, if this looks a little bit confusing, you don't have to leave these lines up here. You can move them if you want. I like leaving them sometimes because it just gives me an overall idea of where the market is. And it lets me know that I should only be focusing inside of this zone right here. And it lets me know that all I have to do as a trader right now is wait for price to actually have a retracement into this zone for the market to have a reaction from there, or let the price come into this zone and then let the market have a reaction from there. This right here is what 99% of traders cannot do right. Traders cannot identify trend. Traders cannot identify market structure. They can't even tell where to properly put an area of interest or where even the market is. Now, we can very clearly tell if we were just going to look at this market based off of market structure. So if I were just to look at this for the structure of the market, which is what we should always look at it, but on the candlestick chart rather than the line chart. But if we were to look at it just on the candlestick chart, just so you guys get a visual, if you look at this without any of the drawings, what does this look like? If I were just to focus on this move right here, this looks like a perfect break, then a retest to this structure point, and then a push to the upside. What a coincidence that that structure point happens to be the weekly area of interest and also the daily area of interest, and also at that daily higher low. If I were to pick an area of interest, if I were to pick one over the other, I would for sure pick this one, just because it's more of a textbook trade. When you see a textbook move, you see something like this, comes back to this structure point, and then it just continues to go up. If you ask me, that is exactly what this is right here. That is the previous structure point. That is the break. And now we are on the way to retest that to potentially have this move to the upside. So that right there is just basic market structure. I have taught you guys what is top-down analysis, how to use these time frames in sync to determine if something is bullish or bearish, and how to place a proper area of interest. All of this is quote unquote still very beginner stuff, but also getting into a bit intermediate, just simply because all you need now is just practice. Go out there and go practice this, because that is going to be the crucial part of you to actually perfect it and see it as effectively and as quick as I do. But to this right here, what I am showing you guys, this took me a year to understand, a year to really like get it and like put it into practice. This took me such a long time and so many wasted hours of just placing market structure incorrectly, putting areas of interest in areas where it didn't even make sense. Just so much wasted time, which obviously led to waste of money that you guys can't even fathom. Like, I'm making all of this in one video, but I also don't want to overload you on information that it's just me repeating myself, and I want to make sure that you get the point perfect, and then you can go on and go practice it, right? So right now, that is top-down analysis. That is how it is worked. We do a top-down analysis from the weekly to the daily to the 4-hour to determine if something is bullish or if something is bearish. Once we determine that we have 2 consecutive time frames in sync, how we have here for the weekly time frame, where this would be the higher high and this would be the higher low, we then go ahead to the daily time frame. We identify the higher high and then we identify the higher low. We then just do it on the 4-hour just to see if we have that added time frame. Then we place our areas of interest within these higher highs and higher lows, and then we can tell that we're only looking at this right here in the market, and we're waiting for the market to come back, retest this zone, apply the strategy here. If we don't get it, then we wait for the strategy to get applied here. Now, once again, if the market for some reason somehow breaks below this area of interest, could we then have a reaction from the middle of this area? Do we buy in the middle? No. Do we buy at the bottom? No. You have to wait for the break of it, come back, retest it, and then you have the trade to the upside. This right here would be the perfect trade setup. As long as we are above the support level, we either take the trade fully at this area of interest, or above this area of interest, or above this area of interest. There's no ifs, ands, or buts about that. You need to buy at a support and you need to sell at a resistance. Now, for a sell, pretty much just the complete opposite. You can literally just flip the chart, you right click this section in trading view, and then you click invert scale, and then it's pretty much the same exact thing. You have the bearish move, you have to wait for it to come back to retest this structure point to then sell, or you would have to wait for price to then come back and then retest this structure point over here to then sell. Either one are equally as strong, and each one of them are equally as valid. You just have to wait for the strategy to be aligned at that point. So with that being said, let's move on to our next point, which is going to be kind of hand in hand with what we are talking about with right now. And it's probably going to be one of the most common things you've heard, if you've heard anything about trading, and probably one of the main things that I personally use on a daily basis. And it's going to go hand in hand with everything that we're talking about right here. And that is going to be break of structure / break and retest / chotch / shift of structure. All of this right here is almost the same thing. This one right here is the only one that is different to every single one of these. Break of structure, chotch, and shift of structure are all the same shit. So let's start off with break of structure, right? This market right here is clearly bullish, right? We know that already. We know that this is the higher high, and we know that this is the higher low. Cool. What happens if this does this? Well, shit. Fuck. We just broke the structure. We broke the higher low. We shifted the structure. We chotch. What the fuck is chotch? I don't know. All these fugazi traders came up with this shit. Chotch is equal to change of character. This is what chotch means. Change of character. Change of character. They were identifying this, that the character, or the what it identifies as, was bullish. Now it has changed that identity to now bearish. Same fucking shit as shift of structure. Same fucking shit as break of structure. That shit pisses me off how they put all these different names to all these same exact shit. They just fucking complicate everything. Change of character is when the market shifts, when it changes from bullish to bearish. Simple. Break of structure is when this is the previous structure and we break it. Shift of structure is when this structure shifts from bullish to bearish. Easy. Change of character is when you change identity from being bullish to then being bearish. Simple. Now, what is breaking? And you guys already know this. I have pretty much have been doing this for the last 2 hours, right? Doing shift to structure, doing breaks to structure. Now, what is a break and retest? Now, this one is probably the easiest one to explain. So let's say price is currently being held up at a resistance level, how we were previously, right? Or how we were doing for these examples, right? So this right here is a valid level of resistance. So the resistance is clearly trapped within this spot right here. And we know we cannot actually enter the trade at this resistance. What would we need for the market to do? We would need for the market to break above this area and come back into this area to then actually buy. We need to buy above it. Well, this right here is called break and retest. And break and retest is exactly what it says, like the name of it. It's a fucking break and retest. It is extremely easy. It is extremely self-explanatory. All you do is wait for the break and the retest for you to take the trade to the upside. That is it. It is really that simple. Break and retest are very crucial for you to take, whether it be on an area of interest, whether it be at a resistance used as support, at a support used as resistance. You can only take the trade once you've had the break and then the retest. I get thousands of messages throughout the weeks of asking, hey Alex, can I enter the trade at the break, at the high? Yes, you could. You could enter the trade at the break. Just understand you cannot add that as a break and retest confluence. We're going to get into confluences later into this video. But you understand that it's just a break. It's not a retest. A retest is when something comes back, it retests it, it uses it as support, and then you can be interested in buying the trade to the upside, because that's where you anticipate for this trade to actually have the move to the upside. Could you count something as a breakout and add it as a confluence as a breakout? Sure. But it's always a 50-50 chance if it's going to come back and retest this point. Now, if it comes back and retests this point, it is once again another 50-50 chance that it's going to actually have the reaction from it, because it could have just done this right here, and this is a fake out. This is a liquidity grab, and then guess what? It continued back into this area, and then price stays ranging in the zone or just rejecting this resistance. Personally, myself, I'd say 30% of the time, I get a breakout. I enter at the breakout. Now, the breakout, as you can tell, I'm doing everything based off of market structure. The breakout is based off of the candlestick of the market. It's not based off of the wick. It's not based off of the tail, the dough. It's all based off of the actual body candlestick closing above this zone. So this zone is at these structure points. It's at these bodies. And right now we have a body that has actually closed above this area. That right there is a confirmed break. Now, I sometimes enter on that break, just depends on the momentum, where I am in the week as a trader as a whole, where's my mindset, how much I'm risking, how many confluences I have. But the correct thing to do is to wait for the retest. Now, in the retest, you want to wait for the body to retest this area, and then you get some wick rejections. And those wick rejections is one of your entry confirmations to enter the trade. So can you enter the trade on the body closure above this area? Sure. But you can only enter properly on the retest, and then you need proper body rejections on that retest. Perfect example could literally be this right here. As you can tell, this is a very valid level of resistance. As you can tell here, this is resistance, 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 very valid resistance and area of interest. As you can tell, this right here, these are all wicks. This is not market structure. This is all that price once upon a time at one point was a full blue candle, full green candle, full strong candle up here. But guess what? It was never strong enough, and it always closed below. So that right there makes that a non-confirmation of a break above that area. If we go look at this on the actual market structure, which is based off of the line chart, as you can tell, market structure never broke above that. But the one time that it did break above that, guess what happened? Price came back, and then we retested it. We body candlestick closed above with this very, very strong candle. Then we got a retest, and then we bought. Could you have entered at the breakout? Yes. Would you have much been better off entering at the retest? Yes. But these break and retest examples are literally everywhere in the market. I can just simply go to the left and I can almost guarantee you I can find another one of these in just a simple, like in any possible scenario, in any possible time frame, you can find these examples right here. Perfect example could be this. This right here is technically a resistance level. Resistance level has 3 touches. If we look at this on the actual market structure time frame, you can see how this market structure has more than 1, 2, and then 3. We confirm it with the actual body candlesticks, and yes, we notice here this never body candlestick closed above, never body candlestick closed above, never body candlestick closed above, and guess what? Body candlestick closed above. Let's say in this scenario we were waiting for the retest. Guess what happened? We never retested it. We missed the trade. It is what it is. It happens. Sometimes I enter the trade at the breakout. Sometimes I enter the trade on the retest. Perfect example could be this right here. We have resistance, right? I could just move this resistance a bit more up. And on this resistance right here, you can tell we have resistance, 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 body candlestick close above, retest it right there with that wick on the daily time frame. I know if we go to the 4-hour time frame, it's a much cleaner retest. Beautiful push to the upside. This happens in sells equally as the amount of times. Many times as well, it also has fake outs and fake trades that actually never actually end up having the move. But there's other times where it also gets very much respected. But this right here of a break and retest is the most textbook example that I can possibly give right here. This is a resistance level and it's just one structure point, not as strong as if we were to have 3. But as you can tell right here, we have broken this area, we retested this area, then we head to the upside. Very, very simple. A break and retest is just whenever we break an area and then we retest it and then we head to the downside. Examples like these I can show you literally never ending. Perfect example is right here. This is a very strong resistance level. We broke this area and then we came back and then we retested, we sold off. Another example that we could have is, for example, right here. This is an area where I actually took this loss on this trade right here. This area right here, we actually had this support, we got this break, and then I waited for the retest and I just jumped off on the retest, and guess what? I took the loss. It is what it is. It's okay. It happens. It's part of the process. As you can tell right here, this is a very strong level of resistance, and this right here was the resistance structure. We can go to the line chart to go ahead and confirm that, and once we look at that here on the market structure chart, we can see that this was creating structure points. I don't know why. There it is. So we have 1, 2, 3, 4, and 5. Very clean and obvious area of interest. I would not count that one because the candlestick isn't that clean. 1, 2, and 3, and 4, and 5. We break this area. We retest it. We head to the upside. Break and retest happens every single day on every single possible market that you could imagine. This is probably one of the most textbook things that happen in the market, and personally it's one of my favorite continuation patterns. So a break and retest is a continuation pattern that happens once you are looking to either go with the trend or get out of it. But a break and retest is a trade continuation pattern because this is breaking out of this area and it's continuing in that direction. This right here, as you can tell, this was bullish in this example. It broke above, created the new higher high. It retested it, trade continuation pattern. I can show many more examples of it reversing and then just going in the complete opposite direction. But break and retest is a trade continuation pattern with the market that it's going to be break and retesting for. Now, breakout works the same exact way. So I call breakout the little brother of break and retest. So we have breakout. And that's the example that I was giving. Once we actually have the breakout of the area, you can enter the trade once it breaks out without the retest. I first like building the foundation on break and retest because personally myself, I want to trade with as many possible confluences that I can, and having that extra retest is going to be that extra confirmation. At no point do I want to have overexposure in the markets just because I want to enter a trade. I always want to be as less exposed as I possibly can. So that's why I always create the base off of the retest. And if sometimes I get the breakout, sure, I could decide if I want to enter the trade at that time, but I'm going to make sure that I have in my mind that I need the retest in order for me to actually enter the trade. But break and retest is the exact same thing. You either enter at the breakout once it breaks out with the body candlestick closing above, or you can then wait for the retest. Sometimes you might miss out on some trades, sometimes you might avoid some losses, but break and retest, breakout is the most textbook trade continuation pattern known to exist. So now at this point, you understand a lot, right? You understand the different types of markets that you could be trading. You probably know how to understand top-down analysis and see if something is bullish or bearish. You know on what sections of the market to actually focus on, because the market is huge. There could be a lot of noise either at the top or the bottom or at the middle, and you simply don't know where to actually go and find the proper area for you to go ahead and execute the trade. So now you know the difference between actually finding the top or the bottom of the market, knowing where the market is, and most importantly, being able to place that area of interest, and how an area of interest could be combined with the weekly and the daily, and that you only need an area of interest on the weekly and you only need an area of interest on the daily. You don't need an area of interest on the 4 hour, on the 2 hour, on the 1 hour, the 30 minute, or the 15 minute. Those time frames, the area of interest is simply not going to be as respected. Can you apply the same principle to it? Sure, but it's just going to be a lot more high risk and it's not going to make sense. I personally myself, I think trading already is as a risk as it is, because the outcome is not guaranteed, and I want to minimize that risk as much as I possibly can by simply having the most amounts of confluences or reasons in my favor, and making sure that you're on the higher time frames is that. So now that you understand all of that, you kind of have to like read the more important candlesticks in front of the markets, right? Because the markets are full of candlesticks, all different types of candlesticks, but there's certain candlesticks that stand out and are key candlesticks in the chart. And these candlesticks that I'm about to educate you on right now are basically the top performing candlesticks in the market. And they happen everywhere in the chart. They happen at the areas of interest. They happen in the middle of the chart where there's no area of interest. They happen literally, they happen everywhere. Anywhere that you can think of, it's going to happen. But where they have the most impact is at those areas of interest and at key points in the markets. Now, I'm going to teach you these patterns right now just so you can have them in the back of your mind, and then you can go look for them when you actually see the market. You're going to see them randomly throughout the market, and I say they have a 70% of the time where they are actually respected. But once they're at a key point in the middle of the chart where there's no area of interest, where there's no respected point, they're not supposed to be rejected because there's just simply no reason for them to actually respect that. So you got to make sure that you read these candlesticks for what they are and where they're supposed to be, because yes, you're going to get them in the middle of the chart, but doesn't mean that you just trade them because they happen in the middle of the chart. Once again, they need to happen at a key area of interest. So let's break down these points. Right now, I'm going to be sharing with you these candlesticks, that these are the only candlesticks that you need to prioritize when it comes to analyzing the market. Is there other formations? Yes. I don't know any other formation that works anywhere near remotely as much as these. And I'm actually going to be eliminating some of these just because they're a bit complex and they're not as strong. It's only one of them, and I'll be explaining why in just a second, right? So I'm going to be showing you bullish candlestick patterns, which are going to be these patterns right here, and then I'm going to be showing you bearish candlestick patterns. Whatever I show you on one side, it's pretty much the same thing, but just opposite on the other side, right? So I want you guys to have a clear understanding of exactly how it works once again. So you have the open of the candlestick. So let's say this is a bullish candle. So this is a bullish candlestick, how it opened, and then this is how it closed. This is the highest points in the candlestick, which is where the wick is, and then this is the lowest point where the candlestick was, which is where the bottom of the wick is. Same exact thing right here. You have the open of the markets, and the market closed down here. But once upon a time, it was a green candle creating a wick up here. And once upon a time, it was a very strong red candle all the way down here. But the market has closed at this point. So this right here is how the wicks get formed. And I just want to give you guys a very detailed breakdown explanation. I know we've talked about it already and I've shown it to you, but I think a visual image like this is going to help. One of the main reversal candlestick patterns is going to be a doji and a spinning top. So a doji is very obvious that there's a lot of indecision in the market. Both of these right here are indecision in the markets, but a full doji is a much more clear indecision in the market. A doji is when the market basically closes as a cross or closes as a plus sign, however you want to see it. But what matters is that there is no body in this candlestick. So as you can tell in this example right here, there's a green body and then there's a red body, which leads you to understand that it closed a little bit more in one direction versus the other. Even if it's something as small as that, there's a little bit more red, there's a bit more strong sellers, or they're closed green, there's a bit more green, there's a bit more buyers. If it closes as a complete doji like this, it's a that the market is completely standstill, right? The buyers and the sellers cannot make up who's stronger or who is weaker. And then it stayed with the body like this. This is a great point as an indecision, right? This is good for you to anticipate a continuation move in your direction, or this is just so you have an idea how the market is moving. If I personally see the daily time frame that is having an indecision like this, after it comes back to a strong area of interest, logically in my mind, I'm going to determine that as a slowdown in price. If I see a doji, like this example right here, after I see a market that I've had a very strong push up, and then on this push up, we are retesting this area of interest. Price is back at this area of interest. This is a very well respected weekly and daily area of interest, for example, that they both overlap. And then at this area of interest, I then get a doji candlestick. That is leading me to understand that this pullback is potentially stopping. And now the buyers that are at this support level are going to hold price to the upside. That right there to me is a great indication that this market is now slowing down and that the next candlestick could potentially be an engulfing, rejecting this area. Now, if I were to pick in between both of these, if I were to pick in between a doji or a spinning top, I would obviously much rather have a bullish spinning top, because then that just means that the buyers are a bit stronger than the sellers. But having a doji isn't a red flag either. It is equally as strong, but just understanding that this just means indecision in the market. And this means that there's a bit more on either side depending on which one the body closes in. Nonetheless, this could be used as a perfect reversal and showing you that the market is ready to move in the other direction. That means that the market has been battling to go to either side and it couldn't make up its mind and it closed like this. Now remember, keynote for this, the higher the time frame, the stronger the formation. If you go down to the 1 minute time frame, you're going to get these formations that form every single minute. If you're going to go to the 30-minute time frame, these formations happen every 30 minutes. Why? Because it moves a lot more. It's a lot more volatile. The probability of it happening is a lot easier. I like using these candlesticks to have my entry or to determine if I'm going to enter a trade based off of, like, yes, the 30-minute, the 1 hour, the 2 hour. But where I like to use these indecision candles, and I'm going to teach you how to use them later on, is on the higher time frame. Seeing a daily doji like this at an area of interest, having a full 24-hour candlestick battle up and down and close at an indecision candlestick like this, that is amazing. Seeing a 4-hour candlestick like this, it's also good because it's 4 hours. But then seeing a 1 hour candlestick, it's okay. And then a 30-minute just loses less value. The longer it takes for this to be created, the more respect I'm going to give to it. But this as a whole could be used as a reversal and showing slowdown in the direction that I am interested in taking the trade. This is just a very educational candlestick, and it's something that I use on every single time frame. Just on the higher time frame, obviously, the more respected it's going to be. Moving after that, we then have the hammer and the inverted hammer. So this is basically very similar to the spinning top, but this is something that would happen once we have reached this support level, and then we basically close with little to no wick on the upside. So this means that the momentum is extremely strong and the market opened up. Sellers brought this price all the way down, but buyers were so strong that it brought it all the way up and actually had it close to the upside with that momentum. So this was going to be a doji, where it was going to be a full cross, but then the buyers were so strong that it actually made it end up closing to the upside. This right here is an additional very strong and very powerful reversal pattern. I like to have this one as well, as once you have approached a support level, because then this is showing that we are obviously rejecting it and then we have taken out the lows. Next, we have the inverted hammer. So the inverted hammer is actually what I like to call a wick fill. So that wick right there, because it's happening in the favor of the direction that we're going in, is where the next candlestick could anticipate to then fill that. And we notice this next candlestick has filled that perfectly. So if the wick is to the downside, it's a rejection. If the wick is to the upside, it's a fill. Only if we're at an area of interest. Now this could, again, work on the 1 hour, the 4 hour, the daily. The higher the time frame, the better. So if this right here, you get it, that's great. That's a rejection. Could the next candlestick from that be a bullish engulfing? Yes. If this is a wick like this, could the next candlestick be a bullish engulfing? Yes, they're both equally as strong. I just personally like the wick fill a bit more. Just really depends on the trade. But don't get me wrong, a strong wick or a strong hammer is a very strong rejection. Next is a doji, is a dragonfly doji. So this is the bullshit that I'm talking about. This is pretty much the same shit as this. They just decided to make the body a little bit smaller, and at the end of the day, I'm gonna call it a hammer or a doji no matter what. You might see me call it doji more than dragonfly or a hammer. But this is the exact same thing. I don't want to waste your time or get you distracted on having to remember the dragonfly doji when it's pretty much the same shit as the hammer. It just has a smaller body, but it means the exact same thing. One is not stronger than the other. The one that is stronger than all of these is going to be the actual bullish engulfing candlestick. So this bullish engulfing candlestick is one of my favorite reversal patterns because this candlestick is showing power, is showing strength, and is showing that we are literally going in the complete opposite direction. It is showing that we are literally engulfing the bears and we are going with the buyers. This candlestick needs to engulf the last candlestick and then the previous one minimum to be considered as a bullish engulfing candlestick. That's how I personally consider the bullish engulfing candlestick. Others like for it to just be the previous small candle. I like for it to engulf a minimum of 2 candles just to show the strength of it, because that is what's going to lead me to enter the trade and have more confidence that it's going to go in that direction. So if you have a bullish engulfing, that means you want to buy in that direction, and once again, that would happen at a support level. If you have a doji, or if you have a hammer, or if you have a inverted hammer, whatever you want to call it, and then the candlestick after that is going to be a bullish engulfing candlestick engulfing the hammer, and then the bearish candlestick that it was right here. That right there is the perfect formation in my opinion, and that is also known as the morning star formation. This pierced line, and I just jumped right through it. This is fucking bullshit. I don't even know what this is. This is just, they made up this formation. In my opinion, it's not even real. They just tried to like take value away from the bullish engulfing and validate something when it's not there. If it's not a bullish engulfing, it's not a pierced line. They tried to make something out of nothing. No, if it's not an engulfing, it's not strong enough. I'm not taking the trade. I am good. And trust me, I tried to figure this shit out for way too long, and then later throughout my journey I realized that I was just wasting my time, and it makes more sense to just focus on one good candlestick formation, and that's it. My favorite and above all is going to be the morning star formation. The morning star formation, or the morning doji star formation, well, once again, it's the same shit. They've pretty much just added an additional verb to it. Is going to be that this candlestick has engulfed both of these candlesticks, and it has that doji that I was just explaining. Either you have this bearish candlestick right here and this one engulfs, or if you have the shooting star to the downside, you have a bullish engulfing candlestick with the doji. That right there is a morning star formation. This is my favorite end all be all candlestick formation, because what it essentially does is it combines the bullish engulfing and it adds it in with the inverted hammer or the doji, and you're putting the engulfing and the doji together. Now obviously, if this example right here were to have a wick like that, even better. But if it doesn't, it's fine. All that matters is that this candlestick has engulfed the last 2 candles, and that is what makes it a morning star formation. Last and definitely least is going to be this right here, the 3 white soldiers and then the 3 black crows. I don't know how it goes from white soldiers to then black crows. I don't even know how this makes any sense. This candlestick formation is not even a real thing. If you ask me, it looks exactly the same as the 3 cloud clover. This 3 cloud clover looks exactly the same as the 3 black crows. 3 red candlesticks, 3 red candlesticks, looks exactly the same to me. These formations are total bullshit, and they're simply a waste of time, and there's no need to even focus on them. It makes more sense to just focus on a formation that actually makes sense, like the morning star formation, the bullish engulfing, and then the hammer. That is all you need when it comes to these candlesticks. Now, for the bearish examples, it's pretty much the exact same thing, just the complete opposite. The shooting star is going to be happening at a rejection, as it's going to be happening at a resistance. So if I just delete all this right here real quick, the shooting star, you want it to be at a resistance. So let's say this market is trending to the downside, and now we are retesting this resistance level right here. this resistance, you're at this resistance level. And then once again, the camera battery has died. I guess I've been doing this for a while now. I don't even know how much time I'm into this video, but I will tell you this, I'm loving it. I am very committed to continue doing this right now. 1 second. And we're back over here now with the other camera angle. So over here on this bearish example, we have this market being a bearish trending market, and we are at this resistance level where we're going to potentially be using it as resistance. Now these market indications, these market patterns are going to actually give us the indication that we're actually rejecting it. So once again, price could come into this resistance level and then give us a shooting star, whether it be with a very small body, whether it have a small body so it looks like a doji, so it looks like a hanging man or a shooting star. As long as we have some type of rejection at this area of interest, it is considered, in my opinion, a doji. So this gravestone doji, this formation right here, is the exact same thing as the hanging man and the shooting star, in my opinion. Now, if you combine that with the bearish engulfing candlestick, that is where you have the beautiful formation, whether it's a doji or a shooting star or a hammer, however you want to call it. I just call them dojis, honestly. It's just so much fucking easier. So then this bearish engulfing candlestick is what's going to give you that beautiful end all be all evening star formation. This is the most beautiful formation, morning star and then evening star formation. And once again, this right here, they just figured out a way to remix it and add the actual doji into it, but it's all the exact same thing. As long as the candlestick engulfs the last two, you have a beautiful formation where you have a combination of a shooting star and an engulfing candlestick, which makes the morning and evening star formation. Now, these candlesticks, you're literally going to see them everywhere, right? We can come here into the chart and then look at this, for example, right here. This right here is a bullish engulfing candlestick. This candlestick has engulfed this candlestick. Guess what happened after? Continuation push. Here we have a pullback to this retracement, break and retest. What do we have here? A beautiful hammer, shooting star, doji, whatever the actual name was. It's that type of candlestick. What's the candlestick you get after? A beautiful bullish engulfing candlestick that eats the last two candlesticks. This right here is my formation of a perfect morning star formation. This right here is a beautiful formation. Continuing to this area over here. Bullish pin bar rejection, beautiful continuation push to the upside. What do we have here? A beautiful morning star formation with these very, very long doji wicks, showing this indication that we are indeed rejection, meaning once upon a time we're fully red, we rejected. We were fully red, we rejected, and we closed bullish. Obviously, look what happened after. So as you can tell, things are never going to come out exactly textbook how they are here in the picture, right? I wish, but I'm not here to sell you a fantasy. I'm not here to sell you a dream. I'm here to tell you shit straight up how it is. It's never going to be perfect, picture perfect, exactly like this. It's going to have the formation, and then it's going to be a little bit ugly. Kind of like when you go on a date with a girl you meet on Tinder. Like on the pictures, they all look great, but when you meet them in person, it's all like, whatever, I'll do it. Fuck it, I'm already here. Kind of vibe, right? And it ends up being a great time. It's the exact same thing. This, for example, right here is a perfect doji, bullish engulfing candlestick, break and retest of this area of interest, you buy. You see how now we're combining all of these things at the exact same time. We have this very strong trend, right? This is obviously being a bullish market. We have a break of this strong resistance. We have a retest. We have a morning star formation with a doji. That right there, just right off the top of the bat, I just gave you 5 confluences on why you should take this trade. You have 2 time frames in sync. You have area of interest, you have break and retest, and then you have a morning star formation. 5 confluences in 30 seconds on everything that I have just taught you in this video could have easily gotten you to enter this trade at this retest, have a very simple stop loss, and with a 1 to 2 risk to reward, you could have made 118 pips. You multiply whatever you were going to risk times 118, this is easily a $5,000 to $10,000 trade. Just showing you guys how simple it is, and I'm just educating you guys on things that you are already seeing and I have been showing you, but you just didn't even know that they were there. It's almost like playing Where's Waldo, right? When you play Where's Waldo, which is this game right here, you pretty much don't know where he is. But as soon as I'm able to point out where's Waldo, you're almost going to be like, wow, was he really there the whole entire time? Like, I already found him. So for example, let's say I spotted Waldo right here, for example. And then once you spot him, I'm totally kidding, I did not spot him. But if you do spot him right off the bat, once you see him, you can't unsee it. It's the exact same thing when it comes to this training view and this examples right here. Once you see these examples, you can't unsee it. Perfect example of a morning star formation being at an area that is not valid and it not working, obviously. If you notice right here, this is a beautiful doji, shooting star, whatever. And then we have a beautiful morning star formation. It's not an engulfing because it didn't engulf this last candlestick right here. But where is this formation happening into? It's happening into a resistance. What happens after it happens into a resistance? Obviously, it's not going to respect it, and then it goes to the downside. This is showing you the example that you can get these formations anywhere in the charts, but you need to get them at key areas that they are going to be respected. If not, it's just simply going to be a complete waste. You get all of these types of formations I'm talking about everywhere in front of the markets at every given point. A perfect example is right here. Very small morning star formation. This candlestick could have been bigger, and maybe it would have made a difference, but that right there to me is not a strong morning star formation. I like for that morning bullish candlestick to be strong. I want it to engulf. That right there is the indication that it's going to continue going in that direction. I want it to be in control. Perfect example is like this one right here. This right here is a beautiful morning star formation, bullish engulfing candlestick. It ate the last two candles, beautiful push to the upside. This right here is an evening star formation, and then it did not really engulf this candlestick right here. So we had a little bit of a push, but then we continued going to the upside. This right here is a very clean bearish engulfing candlestick, and then we had a very strong push to the downside. Very clean evening star formation. Right here as well, we're using this as a resistance point right here. And then guess what? Price has a beautiful evening star formation, beautiful push to the downside. Down here, we have a morning star formation. This candlestick never really engulfed this one. So what happens? We break to the downside. This candlestick engulfs this candlestick, beautiful push to the upside. This right here is a beautiful morning star formation. This right here is, if I were to pick a formation that I can have time over time again, it would literally be this one right here. Beautiful morning star formation. This candlestick engulfs this candle and this candle, because this is the last candle. You want to make sure that it can engulf the body of that move, not the wick. You want to make sure that it can engulf the body. And if this body closes above the body, that is a beautiful engulfing candlestick of the last two candles and having a beautiful push to the upside. So for example, this move right here actually had a beautiful bearish engulfing candlestick. It engulfed below this body right here, simply did not have the move. There's times where that is going to happen as well. But I love when the candlesticks actually engulf the last body. That to me is the most Picasso thing the market can ever do. Look at these beautiful morning star formations back to back that just happened right here. This right here, like I would literally screenshot this and frame it and put it on my wall. Beautiful morning star formation with a very slight, I'm talking about a hairline break above the last body. That right there, believe it or not, is the difference between an engulfing and not. And if you were to see this one as well right here, this one as well has a beautiful morning star formation, and that candlestick has very clearly body candlestick closed above. And look at the beautiful continuation push that it has had to the upside right after that. These formations are extremely powerful, and they're going to happen time and time again. Like for example, this right here, this happened at a low of a market. This is a continuation pattern. This is not supposed to happen at the bottom of a market. If we're identifying if this is bullish or bearish, clearly this would have been the higher high. This would have been the higher low to a certain point right over here. My trading view sometimes glitches. So this would be the higher low. If we were to look at this based off of the market structure, this market indeed would be bearish, right? So this would be the lower low, and then this would be the lower high. Let's see how clean that looks on the candlestick chart. Arguably that can't be the lower high, so then let's say that would be the lower high. It's not a one candlestick pullback. So this is a bearish market. I don't expect for a morning star formation to have a reaction on a bearish market. This formation is supposed to happen on a continuation. This is a continuation. If this was bullish, this was at a support level, I would expect for this beautiful pattern to actually have a push. But obviously, since it's happening in a bearish market, it simply has no use compared how it would if it were to be in a bullish market. So that is the importance of learning how to use these formations at the right times, because they're going to happen at all places in the markets. They're going to happen while the markets are going up, or the markets are going down, or the markets are going anywhere. But you need to make sure that you're actually applying it in the proper timing of the market. You need to apply the morning star when you're buying. You need to buy the evening star when you're selling. It's very clean. Morning star when buying, evening star when selling. Very simple, very self-explanatory, everything straight to the point. So there's hundreds of other formations, right? There's other different types of candlestick conformations. There's other different types of confluences for you to actually use in your favor. But the most powerful ones are simply going to be the shooting stars and then the engulfing candlesticks. You use that in combination with a strong support level or a strong resistance, and you already have a recipe to have more than a 50 to 55% odds in your favor of a trade going in a certain direction compared to the other. All right, ladies and gentlemen, now we're going to move on to the next subjects, right? So up to this point, we've talked about a lot. Now, if at any point, from this point going on forward, you don't understand something, you don't have clear the market structure, you don't have clear certain candlesticks, you don't have clear when it comes to the break and retest, to the line charts, to the support and resistance, areas of interest, if any of that stuff is not clear, take a pause at this moment. You are pretty deep into the video as it is already, and we have talked about a lot of things that have taken me a very, very, very long time to actually understand and perfect. Now, I don't expect for you to perfect it right now. That will pretty much be impossible, because the only thing that's going to perfect it is repetition and time. Looking at it in the markets for yourself, setting up certain examples, and just going over it over and over and over and again. I didn't perfect this until about 4.5 years in my journey, simply because I wasted 2 years on just having a bunch of misinformation, and then it took me about a year to actually really learn it and perfect it, simply because I was by myself. Obviously, if I was with a mentor, I was with somebody that would teach me live every single day, kind of how I do every single day with my students, that would have actually escalated and shortened my journey. I would have escalated the amount of knowledge that I actually learned with stuff that matters, and it would have removed all the other bullshit. So I wish I knew that earlier, but obviously, you know, that's why I'm doing this video now for you guys. So once again, if at this point into the video, there is something that is unclear, pause, go back, refresh your notes, watch it over, because what we're going to be talking about now are going to be pretty advanced stuff, and it's going to have everything intertwined and everything connect together. Market structure is going to come together with patterns going to come together with indicators. All of this is going to start coming together. What is a intercooler? And now we're going to put all that together, which is going to make the engine work. So that's exactly what we're going to get into now. Things are going to get very, 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 how do I say it? Interesting from this point forward, right? So all I can say is pay attention. Don't watch this video on 2 speed. Watch it on 1 speed. Just make sure you're actually doing this effectively, right? So the last topic that we have talked about was break and retest, right? Break and retest, we understood that's when something literally has the break of an area, we then retest it to continue going to the upside. So that right there is going to be a trend continuation pattern. That is my favorite trend continuation pattern when it comes to the break and breakout retest. Breakout, break, and retest are trend continuation patterns. Now, there is reversal patterns. So these patterns also let you know that the market is going to go in the opposite direction. So a reversal means that something is going to go the other way. What is a pattern? A pattern is something that has happened in the past. So a reversal pattern is a pattern that's going to tell you the market is going to shift. So the main, and once again, there's hundreds of reversal patterns out there, right? So I can go here into this pattern section, and you know, you're going to get the X, A, B, C, D, Y pattern. I don't even know how to place this shit, but yes, there you can get any endless amount of examples. You can get whatever this is right here, and I will never know how to teach you this because I've never used it. I can only teach you the one and only pattern you are going to need, and that is going to be the head and shoulders pattern. Now, once again, if you have seen me anytime in the past trade, if you have seen any of my clips, if you have seen me anywhere on social media, you would know that I have made so much money off of this pattern right here. This is my go-to pattern. Like, this is my shit right here. I use this every single day in the market. I wait for this pattern to create, and it's not so much about the actual pattern, it's what this pattern actually means and how it does it. And I'm going to make it make sense in just a second, right? So my favorites and the only reversal pattern that you're going to need is going to be this head and shoulders pattern. This is where you have a left, this is where you have a head, and then this is where you have a right shoulder. So a regular head and shoulders pattern is a reversal for this market to continue now going to the downside. This head and shoulders pattern gets formed, and you guys should be writing this down. This gets formed at the high of a market or at a resistance level, and then you have this reversal pattern that then lets you know that the market is now going to start shifting to the downside. At the bottom of a trend, you will then get what is called a inverted head and shoulders, which is literally the complete opposite. But this is now a reversal pattern to let you know that this market is now going to go to the upside. So there's a big difference in between a reversal pattern and a trend continuation pattern. Reversal patterns literally mean the market is going to shift the other way. Trade continuation patterns, like the break and retest, are when market is continuously going in that direction. These right here are constant break and retest to the upside. These right here are constant break and retest to the downside. These right here are constant breakouts, break and retest to the upside. This right here is a reversal pattern, and it changes the trend of a market. This right here is a reversal pattern, and it changes the trend of the market. Now, once again, this reversal pattern, and like every other pattern, every other important point in the market, this head and shoulders pattern is done. I'm going to call it head and shoulders, is done to the market structure. So what do I mean by that? Well, that is done to the bodies of the candlestick. We are not including the wicks at no point when identifying a head and shoulders. I'm going to teach you guys how to put this up on the chart right now, but I want to educate you guys on the head and shoulders first. And everything that we're going to be doing is based off of market structure. So this is what a pretty head and shoulders looks like. But a real head and shoulders might look something like this, for example. Might be at a slant. You might get a head that is a little bit smaller than the right shoulder, and then you go get something like this. You can also get a head and shoulders pattern that can be something like this: a big left shoulder, a big right shoulder, and a small right shoulder. Vice versa, you can get a very small right shoulder and a very big right shoulder. You can get the structure point to be up here. You can get the slanted head and shoulders this way. You can get the slanted head and shoulders like this. The head and shoulders is never going to be a beautiful textbook head and shoulders pattern like this. Does it happen? Yes, but I will never aim to always have a perfect one. The head and shoulders pattern is valid as long as it breaks the neckline. Now, what does that mean, Alex? What do you mean breaking the neckline? Well, the head and shoulders pattern, yes, it is a head and shoulders pattern, but what is this right here, right? Give me 1 second. What is this right here? This right here was a higher high. This right here was a higher low. What is this right here? That is a shift of structure. That is a change of character. That is a break of structure. This is now bearish, right? You got that, right? Confirmed. Now, this right here, what is that right there? That is our potential right shoulder. So without you guys even realizing, I have been showing you guys the head and shoulders this whole entire time. Like if you guys go back into this recording, literally just go back 5 minutes, for example, literally just click the arrow back. You guys are going to see that I've been showing you the head and shoulders this whole entire fucking time. Is that I just never really exposed it to you. And now that I explained to you what it is, it's almost like, oh my God, it's been right in front of me the whole entire time. You just haven't realized it. But there's a big difference in between a valid head and shoulders and an invalid head and shoulders. Now, this right here is a valid head and shoulders because we have broken this neckline. Since we have broken this neckline, this is a valid head and shoulders. Now, this right here is not a valid head and shoulders. We all know this, right? We know that this right now is a higher low and that this is a higher high. We have gone through this 100 times already. This is a higher high. This is a higher low. And we know since we have not broken below this, we are still bullish. This market is still very much bullish. That is the higher low. That is the higher high. A reversal pattern, which is exactly what the head and shoulders is, it needs to be a reversal pattern. Now, what is the best indication to let us know that this is a reversal pattern? That we have shifted the structure. That means that this market is now changing from bullish to bearish. It is shifting. It is breaking the structure. So there's two ways that the head and shoulders could be valid. The head and shoulders could be valid either if the head breaks the neckline, making this the lower low, and then we have a potential lower high for a new lower low. So this would be a proper head and shoulders shift because of this point right here. So you can take the trade either at the right shoulder or at the break and retest of the neckline of the head and shoulders. So the way that the head and shoulders works is you can either sell at the right shoulder or sell at the break and retest. Selling at the right shoulder is extremely high risk. I don't recommend it unless you're an experienced trader. Selling at the break and retest of the head and shoulders is where it is the proper reversal trade confirmation, because you have the confirmed shift of structure. The market has officially shifted bearish, right? So if you have this shift right here, making this the lower low, technically this could come back here, create the lower high, then this is an area of interest up here, right? Let's just pretend like this has 3 touches over here. Yes, you can sell at this area of interest. This could be a sell. This could be your right shoulder, and yes, you can sell at this point right here. But the proper trade is to sell at the retest of the neckline. Now, the neckline is not going to be diagonal because of this tool. So if you place this tool to these structure points, technically it's going to come out diagonal. No, the neckline is going to be based off of the previous structure points, which is basically where the higher low and the shift has been created, which will be right here. This is the neckline. The neckline is not going to be this imaginary line that it gets drawn depending on where the structure is. That's not how the neckline works. The neckline is right here. It's always going to be at an area of interest as well. So the neckline of the head and shoulders is going to be the retest of an area of interest. So now that you have multiple confluences at the same time, you have a shift of structure, you have a reversal pattern, you are breaking and retesting the neckline of the head and shoulders, and that also happens to be an area of interest. You're seeing how everything is just kind of coming along together, right? So one of the ways that you can execute the head and shoulders is if it indeed breaks this higher low, and then we can sell at the right shoulder if we're at an area of interest, or we can sell at the retest of the neckline. That is the one way the head and shoulders will be valid. The head and shoulders will only be valid, and you guys should be writing this down. The head and shoulders will only be valid once we break the neckline. If we have not broken the neckline, we cannot count it as a head and shoulders because it's not a confirmed head and shoulders. This can basically come up into right here, even though that it's bearish, right? Because this right here would be the lower low. And then this over here would now be the lower high. And guess what? This can literally create an equal move and then have a move to the upside. And then now we are bullish and we shifted above this. We cannot confirm that this is a head and shoulders until we have not broken the neckline. The neckline is the most important move for us to consider the valid head and shoulders. Can you take it at the right shoulder? Yes, it's an extremely high risk, and that is up to you depending on what you want to do. But the proper trade is at the break of the neckline, right? So this is the first example, and this would make this head and shoulders very strong because it shifted structure once, and then it's going to shift the structure pretty much for a second time over here, because then this will turn into the lower low, and then this will turn into the lower high, right? Or that's scenario one, meaning that the head breaks this higher low, so it sets up the perfect right shoulder. Or the second way that you could do it is if the market is like this, we are still very much bullish. This is the left, this is the head. This right now, instead of it, because if you were to look at this market like this, at no point in your life are you going to be like, yeah, that's going to be a right shoulder. No, you anticipate for this to have a move like this. This market structure is bullish. You don't expect for this to do this. This is bullish. You expect for this to continue going to the upside. But for this example, let's say it's doing something like this. Now you can look at this market and be like, damn, that is setting up a perfect head and shoulders. Let me take the trade now. Well, you taking the trade now, one, you're not selling at an area of interest. Two, you're selling on a bullish market because this is the higher high and then this would be the higher low. So you're already doing two things that simply just don't make any sense. Go find me enough reasons for you to sell this trade. None. You're trading against the trend. You're already making a mistake. People try and jump the gun and trade based off of a potential head and shoulders. That's not a confirmation. A confirmation is when it actually has the break. So this right here would just be the potential right shoulder, and this would be a confirmed head and shoulders. Once again, once we have broken the higher low. Now, once we have broken the higher low, all we simply have to do is let price come back into this area, retest this neckline, and then we will sell. So if this has broken this area, guess what? That means that this is now the lower low, and this over here is the lower high. If this is the lower high and this is the lower low, what did I just teach you guys? I taught you guys that you're going to find an area of interest in between this lower high and lower low. Start working your way up, and boom, what do you happen to find right here? This right here is an area of interest with 3 touches. And what a coincidence, it is also the neckline of the left, the head, and the right shoulder. That right there is how you're piecing together market structure, how you're piecing together area of interest, how you're piecing together trend and a reversal pattern. Everything is just coming together, right? And this is just one of the things that I'm going to be teaching you right now. So once again, if there's something that you don't have clear, just take a pause, go back, double check it, and then come back to this point right here. And if you're not subscribed, hit the fucking subscribe button, right? So let's continue to go on with the head and shoulders pattern, right? Now, for a bearish example, it's basically the exact same thing. This market right here was creating this lower low, and then this over here was creating this lower high, right? This market structure, let's just pretend like this market is like this. This right here is the lower high. This right here on this lower high and this lower low, what do we expect to happen here? We expect from this move right here to continue to go to the downside. At no point do we expect for this to come over here and then retest this and then actually have a reversal to the upside. This right here, if you would see this, you would still very much count it bearish. Now, some people are better buyers than sellers. Some people are better sellers than buyers. It's entirely up to you. Once again, if you don't have a clear indication on how to do that, you can just flip the chart. But the principle applies exactly the same. Nothing will change if it's bullish or if it's bearish. It's literally the exact same thing, right? So this right here, we understand that this market is indeed bearish. Lower high, lower low, we haven't broken above, nothing changes. Now, if this does this, now guess what? We have the confirmed break of this lower high, making this the higher high. And if this is the higher high, we get the head of the snake, the first turn, that is going to be the higher low. So then this turns into the higher low. That turns into the higher low. We could only find an area of interest inside of this higher high and higher low. And what a coincidence that it is literally at the neckline of this left head and right shoulder. So you simply draw your head and shoulders. Obviously, it's the exact same example. I just flipped the chart, but that's really how easy you can tell the difference in between one or the other. So in the chart, it's going to be exactly the same, exactly just like this, right? So this right here is the lower low, and then this over here is going to be the lower high. So us as traders, we do not enter the trade on the breakout of the neckline. We have to wait for price to come back into this area and then retest. And then once it retests, then you look for those candlestick formations. Here, since you're looking to sell, you look for a bearish shooting star and then a bearish engulfing candlestick to then continue pushing this trade to the downside. That's pretty much it. That is exactly how the head and shoulders works. I can literally show you, bro, I'm talking about like hundreds of these examples every single day. I'm going to show you with a real life example right here. So this right here is a ugly head and shoulders pattern. So as you can see it right here, this right here will be a left head and then a big right shoulder. Guess what? We came back over here. We broke above the right shoulder. We broke the right shoulder. We retested the right shoulder, and then we started to have the push to the downside. You guys remember when I showed you guys this trade before I was interested in taking it, how I was actually interested in taking it? Well, look how it's moving now. Look where it is now, all because of this 1 hour left head, right shoulder. The head and shoulder is equally as valuable. And I mean, it is used equally the same on every single time frame. Now, obviously, the higher the time frame, the stronger the pattern is going to be. But it's used the exact same way. You have to wait for the break of the structure. So for example, right here, if we are looking for this example right here, this, if we were to look at it on the market structure, you can see how we have left head, and right here you never really anticipate a right shoulder until you actually start to see it being created. So that right shoulder there is looking a little bit ugly, but it is creating a right shoulder. And as you can tell, this is the higher low, that's the higher high. We shifted the structure, so that's a good head and shoulders that we like to see, but we never got the break of the neckline. So we're waiting for this break of the neckline in order for us to then actually sell this trade. So as you can tell, no break of the neckline. There we almost broke the neckline. We did nothing, went up to the upside. And then over here, we actually broke the neckline, came back and retested it, and then we had a beautiful sell to the downside. This is just based off of pure market structure. You can see here how this was a head and shoulders, that it never broke the neckline. Left, head, and then guess what? This right shoulder, this was the higher high, and then this was the higher low. The market never broke this higher low and never completed this right shoulder. It never created a proper reversal pattern. Now, don't get me wrong, you're going to get these head and shoulders literally everywhere in the market. I'm talking about in the middle of the chart, at the top, at the bottom. You want to make sure that you can get this reversal pattern on areas that it actually will have a significant impact. You want to make sure that you're getting this head and shoulders pattern at a resistance if you're looking to sell. You want to make sure you can have it at a support if you're looking to buy. Perfect example of a beautiful head and shoulders could be this example right here. Left, head, right shoulder. Doesn't look clean on the candlestick chart? Don't worry, go to the line chart. Beautiful. I'm talking about beautiful. Left, head, and then right shoulder. Price broke the neckline. We came back to retest it, and then I ended up taking a loss. And I'm a real one for doing this. You know, like I am in control of this video right now. I can just pause the video and then just go find the perfect example, how it actually happened on that perfect example, and then just show you how it wins every single time. But I'm not going to do that because that's fucked up. Like I'm showing you guys real life examples on trades that I personally have taken and trades that I have actually either made money or lost money on, even if they're not as perfect. It's gonna, you know, it benefits me far more because you guys will like me a lot more if I just set a perfect example and show you how exactly how it looks on a perfect scale and show you how it works every single time. But that's not the reality of this, and that's the mistake that a lot of these mentors make while they're making these videos. They always try and find a perfect example just to show you so it makes sense. I'm not doing that. I'm making it make sense with real life examples, so you guys, when you guys go out there to the real world and go trade the real markets, you're not fucking lost and you actually understand shit. And even though you have a perfect head and shoulders pattern like this one, you can actually understand that there's still a risk of losing no matter what. So I'm protecting your capital. I'm just looking out as much as I possibly can. So just wanted to set that tonality because I've realized it throughout the videos that I could have done so many different types of examples that would have made me look better, but it would have not been the reality for you guys. And I just wanted to show you guys that, right? So for example, here, this is another head and shoulders, how this was the higher high. This was the higher low. Price never broke the neckline. We remained bullish. And even though right here, it probably might have looked like it was going to create a beautiful right shoulder from this area, it could have easily looked like it was going to go down and create a left head, right shoulder, excuse me. We did not. So examples like these, I'm telling you, they are literally never ending throughout the whole entire video. These are literally everywhere in the chart. You're going to get them on every single time frame throughout any chart. I'm just looking to the left, finding these head and shoulders when and if they happen, but they happen all of the time at every single place. For example, right here, you have a beautiful inverted head and shoulders pattern right here. So this right here is going to be the left. This right here is going to be the right. The head, excuse me, and then this is going to be the right shoulder. You notice price broke this neckline, came back, retested, beautiful push to the upside. Once again, if it doesn't look super clean, you can go out to the line chart, and then on the line chart, you can see it. Left head, broke the lower high structure point, came back to create the right shoulder, break retest, and then it went to the upside. Examples like these, and I want to find I remember that I caught one the other day. I wonder where it is. And you know, they come very big. They could also come very small. So for example, you can see this right here as like one ginormous head and shoulders. For example, like right here, you have a ginormous left head and then a ginormous right shoulder. Or you can see a smaller head and shoulders right here. Left head and then right shoulder, for example. I'm telling you, these are, it's literally my favorite reversal pattern. If I go down to the 15-minute time frame, you're going to see it more than ever. I think it was NZD CAD. Was it NZD CAD? NZD CAD? No, I think it was, it was NZD USD. Like this right here is a beautiful trade setup that I had. I'm talking about phenomenal. Look at this right here, right? So this right here has a beautiful left head, and then this broke the structure and created this beautiful right shoulder for me, right? It's a very big head and shoulders. Now on this retest of this neckline, I go down to the 4-hour. And when I go down to this 4-hour, I can see right here, what do I see? I see a beautiful left head and then right shoulder, retesting the bigger neckline of the head and shoulders. So this is the big head and shoulders over here. And now this is retesting the neckline. Beautiful head and shoulders at the retest of it. Here's another beautiful example of a beautiful head, left, head, and then right shoulder. We broke, retested the neckline, and then we sold. Right here, we have an inverted head and shoulders. Right here, we have a left, head, and then the right shoulder. Trade continued to go to the upside. Up here, we have another head and shoulders. We have left, head, and then right shoulder, broke, retested, and then went to the downside. Right here, we have another left. These things are just never ending. Head, right shoulder. This right here is clearly an area of interest. So if this was, I mean, you can just look at it. You could just look at this example like this, right? So let's say this is the higher, or let's not say this right here is the higher high, right? For example, this right here is the higher high of this market. This right here is the higher low of this market. We know that this is bullish. So in this market, we now get a perfect retest of this area. So right here, it looks like we're creating the perfect base for the left, for the head. Now you don't know a right shoulder's coming. You just look, this looks like the base. This looks like it's just rejecting the structure to potentially go to the upside, right? But then you get something like this. You get a little high and then it breaks. Now when it breaks is when you realize, oh shit, this shit is actually bearish. This went from being bullish to bearish. Now this higher low gets invalidated. This becomes the new lower low. You do your little snake trick. This becomes the lower high. If that becomes the lower high, then we have to look for an area of interest inside of this lower high and lower low. But first, let's just make sure that this candlestick has actually stopped at this area. We need to have some type of slowdown at this area so we confirm that we're actually having that as the lower low. As of right now, this looks like this became the new lower low. See what happens to the next candle. Okay, this becomes, okay, perfect. That became the lower low. So now we're going to look for areas of interest within this box, right? So we're going to go back out to the line chart. We're going to start working our way up from this point right here. Start working our way up. Boom. Right here we have 1 and then 2. We can potentially have this as an area of interest. Let's see what it looks like on the candlestick chart. We have 1. I'm sure if we look more left, we have maybe 3. 1, 2 doesn't look that clean. If we keep working our way up, we're going to probably run into this area right here where we have 1, 2, and then 3. If we look at it on the line chart, you can tell we have very clean structure. We have 1, 2, 3, 4 structure points. And what a coincidence that it's also the neckline of the head and shoulders. Now, this neckline of the head and shoulders, we're going to wait for price to come back and then retest it. So once price comes back and then retest it, we're going to wait for some type of rejection confirmation like this evening star formation for us in order to enter this trade and have the sell to the downside. So now this is the confirmation that the neckline, the head and shoulders has broken it, has come back to retest it. We have our engulfing, and then guess what? Beautiful sell to the downside. That right there, ladies and gentlemen, is a perfect example of a head and shoulders. And this is just a random chart that I found here on TradingView. Head and shoulders patterns happen literally everywhere throughout the market. I can show you another one right here. Left, head, right shoulder. We broke the neckline, came back and retested. You can see it right here. Left, head, right shoulder. What matters is that it shifted from being this the higher low to this being the higher high. We shifted the structure. So we go from being bullish to then bearish. And then we create the new lower low. Then we come back, we create the retest, and then we sell. That is the beauty of the head and shoulders, that it is a reversal pattern. And it is literally showing you its hand first. You're letting the market create the move before it even like you're letting the market do the move for you, where you're letting the market literally have the pattern so you can just simply follow it. You don't even have to think. All you simply have to do is just react to the pattern. And I know I have many more examples. I think I have one on GBP USD not so long ago that I took as well. That was a beautiful head and shoulders. I think it was somewhere. I can look, for example, right here. So right here, GBP USD, once again, we have left, head, right shoulder. We break that neckline, come back and retest, and then we sell. Examples of these are literally everywhere. And it's just called the head and shoulders pattern because that's just what it is. But it's really just a reversal pattern. For example, right here, you have this market that is bullish. This market right here is bullish, right? This market was creating higher highs, higher lows, higher highs, and then guess what? We shifted the structure. So if this is the higher low, and then this is the higher high. This at this point did not shift the market structure. This market was still bullish up to this point right here. But guess what? We broke the neckline, we came back to retest it, and then guess what happens after? Retest the neckline, beautiful sells to the downside. This right here is the beauty of the reversal pattern. Now, it's not that I'm looking for specifically a head and shoulders pattern. No, what I'm looking for is for this right here, is that shift of structure, the market going from bullish to bearish. That is the reversal pattern. That is the indication that I'm looking for in order for me to be interested in this trade. It's the shift of the structure, whether it happens from the push from the head, or whether it happens from the break of the neckline of the actual head and shoulders. And like, I'm just so passionate about these head and shoulders that I can literally be on here for hours, just showing you examples of head and shoulders alone, just literally head and shoulders everywhere. Like there's another one right here. I'm trying to find like an ugly one, because sometimes there is some ugly ones. I mean, this is kind of like an ugly one in a way, in my opinion, because this one's like not super clean. Left, head, and then right shoulder. All that matters is that we broke the structure, retested the neckline, we then had to push to the upside. I see these patterns happen every single day, everywhere in the market, either at tops or bottoms. And for me, it's my personal favorite reversal pattern, and it lets me know that the market is indeed respecting the structure. Perfect example could also be this right here, this inverted head and shoulders. Right here, we have this left, this head, and then this right shoulder. We break the neckline. So as you can tell, this right here is going to be the lower high of this market. If this is the lower high of this market, and then this is going to be the lower low, that lower high and lower low, guess what happens? We break that neckline, we break that lower high, we break the lower low, we then break above it, come back, retest it, have the bullish engulfing candlestick, and look at this beautiful push to the upside. Like, it just, I just can't get over it. You know, I just can't get over how many times this pattern happens all of the time. Perfect examples right here on a head and shoulders that it did not respect it. So technically, you know, you can call this the left, the head, and then the right shoulder. And if you were to call this right here the higher low, technically it did break that neckline. So if you were to call this the higher low and this the higher high, for example's purposes, this right here, technically it did break that structure, and we did come back and then retest it, and it could have sold off. But personally, I would have not counted this as a right shoulder. For me, that would have just been way too small of a right shoulder, would have not been as clear. Like, I want the right shoulder to be obvious. I want you to actually be able to spot the shoulder. For a perfect example could be this one here as well. And I know I'm beating at a dead horse here, but I know that the repetition is what's going to lead you guys to success. I know that's what's going to make you guys see the things how I see it. Because what makes me a profitable trader and be able to see the markets how I see it, it's not something secret that I know. It's the amount of times that I've seen this, and I actually could understand it better than anybody else because I've seen it so much. Right here we have a left head, and then guess what? We never broke that higher low, so then this never created the right shoulder. If we look at this on the neckline, on the line chart, this is technically going to be the higher high right here. This is technically going to be the higher low right here. So as you can tell, price never broke below that higher low. So while this was creating that potential right shoulder for us to then sell, because right there, that looks like it can create the perfect right shoulder, we never broke below the higher low. We continue having this push to the upside. So ladies and gentlemen, head and shoulders pattern is my favorite reversal pattern, but not because of the actual pattern itself. It's because of how it is done. And that is with the shift of structure from the higher low to the higher high, or once we actually break the neckline, we come back and we retest it, and then we sell. Head and shoulders is my favorite and most effective reversal pattern. Now, to this, we're going to add what is also called as a indicator, right? So an indicator is obviously exactly what it's named, an indicator, right? It's going to indicate to you that the market is either going to do one thing or do another, right? So there's many different types of indicators. Like, we can go here into the indicator section of TradingView, and this area alone, you can pretty much click every single one of these and you're going to have a billion different types of indicators. They all supposedly know what's going to happen next. There is always a new indicator. They're always doing updated indicators. There's always going to be different types of indicators that the market is going to offer. Now, the only indicator that I personally use is the EMA, exponential moving average. Now I use this, so you guys can see it over here, EMA. So the moving average exponential. I don't know why it says EMA and then the wording of it is completely different, but it is the exponential moving average, or the moving average exponential. Potato, potato, the same thing, you guys understand. I only use an indicator by accident. I was never planning to use an indicator. For me, the indicators, I tried to have many different types of indicators. I tried to do the indicator crossover. So it's where you have like 5 of them. And then whenever all of these different types of indicators, whenever they all cross over, that's when you would sell below it. Or whenever the price would cross above all of them, that's when you would buy with it. It's all fucking bullshit at the end of the day. Indicator is a delayed line on the chart based off of price. It's never going to predict the future because it needs the current price to be able to like create the indicator, and it can never create future price because it doesn't have the future price. It's just an added confluence, right? So whenever you see price, you're going to see this little blue line that pretty much just follows it everywhere it goes. Now this blue line is literally exactly what it seems to be. It's like a dynamic support and resistance level that follows price. Whenever you're above the indicator, it is used as support. Whenever you're below the indicator, it is used as resistance. Now, this indicator, like I just mentioned, I came across it by accident. I was just pretty much searching the internet for all different types of profitable indicators, and there's just really one that stuck out, and that is the exponential moving average. For you to get access to this exponential moving average, just type EMA, and then it's going to pop up as the 20, the 50, the 100, and the 200. So I want you guys to go ahead and click on that. And once you guys click on it, you guys are going to see how you're going to get all these different types of indicators that pop up on your chart. You have here the 20. The 20 is always going to be closest to the price because it just moves as close as it can to the price. Then you're going to have the 50, which is the one that I use, and it's this other blue one right here. Then you're going to have the 100, which is a bit further, and then you're going to have the 200, which just is even further. All of these are fucking bullshit pretty much, but there's only one that sticks, and that's the 50 EMA. So for you to get access to the 50 EMA, how I do, just go ahead once again, click EMA, and then you can just click on this section right here. And then once you click on this section, then you want to make sure you can go to the settings icon over here. And then on the settings icon, you're going to go to, or how is it? You double click this right here, visibility, like this. So what you're gonna make sure is that you can go ahead, unclick the red one, unclick the dark blue one, unclick the light blue one, and then you're going to be left with the 50 EMA. The 50 EMA is going to be that orange one. It's already a preset. You notice if I unclick it, it's literally right on top of my blue one that I have. I guess I just have an old indicator that I haven't updated, and I don't care to update it. It's just there, or I can just change it to this one. But as you can tell, the 50 EMA is going to be that middle indicator because it goes right over my blue line that I have right there. It's literally exactly the same. And then that is pretty much how you place the indicator and how the indicator is used. It's basically a dynamic support and resistance. Whenever the price is moving up and you're looking to buy at anywhere in this point right here, you being above the EMA is just an added confluence. If you're looking to buy here, for example, and you're above the EMA, it's just an added confluence. If you're looking to sell over here and you're above the EMA, just something to take into consideration. Over here, you're buying, it's above. Whenever price going down, it's below. Whenever you go above, it's always delayed in my opinion. I just have it honestly because I think it looks cool. But there is some certain scenarios where it happens to line up perfectly with certain areas of interest and certain points, for example, like the 1 hour right here, right? So for the 1 hour, as you can tell, we have the head and shoulders pattern, left head, right shoulder, right? We already understood that. We have the neckline of the head and shoulders. And then guess what? Price broke this area, came back to retest the area of interest, retest the EMA. It retest the area of interest, the neckline of the head and shoulders, and it also happens to have the EMA at that area. It's all a piecing of puzzle all together. If I were to compare this to something of an engine of a vehicle, it's almost like having the hood of the car. Do you need the hood of the car to drive the car? No, at all. But it completes the car, right? Can you remove the hood and still drive 24 hours without the car turning off? Yes. Can the hood be off, it rain, and the engine still be fine? Yes, of course. The hood does nothing other than just give the car an aesthetic look, and it just completes the vehicle. And it also protects your engine parts, so I don't know, somebody doesn't steal something from it, but you can drive the car without the hood. So the EMA is like the hood. It's just like the cherry on top. It completes the trade for whenever it is needed and you want to add it as a confluence. For example, on the 1 hour time frame, this EMA is used as a resistance to then sell. But if we were to go out to then the 4 hour, on the 4 hour, you can tell that we are above the EMA, and now it's going to potentially reject it to then head to the upside, potentially. On the daily time frame, we're extremely far from the EMA, for example, and on the weekly time frame, we are even further away from that EMA. So the EMA, it is not used just based off of entry time frames, right? I don't use it just on the lower time frames. For this example, it just happened to line up. I can find a different example of a trade that I took. For example, let's just say this one right here. The 1 hour time frame, when I was interested in taking this trade, I happened to be a little bit below the EMA. Cool, that was an added confluence. On the 4 hour time frame, when I went to go take the trade, I was a little bit above it. On the daily time frame, when I went to go take the trade, I was very above it. So the EMA is really not used at all. I just want to educate you on what it is, so you don't go out there like a maniac trying to figure out the secret formula behind it, because the truth of the matter is that there is none. There is no secret formula to the EMA. Sometimes it's good to be above it. Sometimes it doesn't even matter. I personally, when I go grade my trade, the EMA is literally at the bottom of the list. Like after I do all of my analysis and I do all of my checklists and I do everything, I'm like, oh, where's the EMA? Is it there or not? Oh, it is? Okay, cool. It's not? Okay, cool. It doesn't matter. It does not complete my trade. It does not take away from my trade, and it doesn't do anything for my trade. The only, again, for example, here I'm selling it. We're below on the 4 hour. Cool. Let's see on the 1 hour time frame. What are we doing over here? Trying to make it back over to price. On the 1 hour time frame, perfect. As soon as I sold, I happened to be below it as well. What a coincidence. For this example over here, when I happened to buy, I was below it. So technically I was breaking the rule. The EMA is nothing but a delayed support and resistance. You placing a area of interest like this, how I have placed it right here, is far more accurate than the EMA, because the area of interest is going to be valid for the real market structure and for the weekly, for the daily, for the 4 hour, for the 1 hour. It's all going to be the same thing. Not like the EMA, how it is subjective and it moves based off of the time frame. Depending on the time frame that you are, it is going to be a bit closer, a bit further. It's going to be added. It's not going to be added. Now, once again, there is hundreds of different EMAs. The EMA is simply just a dynamic support and resistance that holds price up, supposedly, whenever you're above it, and whenever you're below it, it pushes price down. It is a delayed indicator, and it has zero importance when it comes to trading. You're not going to build a whole entire trading strategy just based off of EMA. This will be a cherry on top on your trade when you go enter it. If you have it, you have it. If you don't, you don't. So I'm just going to remove this here, so I just don't have that extra indicator for no reason. But the EMA is pretty much just a extra tool, to call it. Now, you understanding head and shoulders, you understanding EMA, you understanding market structure, top-down analysis, areas of interest, blah, blah, blah. These are all different ways on how to read the market. Now, what if I told you that everything that I have just taught you sets up the perfect trade based off confluences? So there's something called confluence trading, and confluences are literally what I have been talking about every single pretty much time that I go trade. Every single moment I have this confluence, I don't have this confluence, I have this, I don't have this. Confluence trading is literally having the most amount of reasons to enter the trade or not. It's like right now I'm trying to invite my buddy out to go out to the bar with me to go drink. I can't even remember the last time I went to I don't think I've ever gone to a bar to go have a beer, right? But just for example, right? Let's say I want to invite my friend to go out to the bar. Hey bro, bars are, I don't even know, it's happy hour. There's going to be a lot of college girls there, and I don't even know what people do at bars, but right, I'm just trying to give him as many possible reasons to convince my friend to come to the bar, right, and go have a drink with me. Bro, beers are half off. There's going to be a lot of pretty women, free nachos, and on top of that, they're playing a football game. You say all that to your friend, and he's like, and you know what, makes more sense to be at the bar than to be at home doing nothing. So you basically made it make sense for your friend to be at the bar with you rather than be home. Confluence trading is really no different than that, but it's just, it's just revolved around money, and you can actually do something with your life, right? You can actually capitalize off of it aside from just wasting your time at a bar drinking beer. So when you go confluence trading, you try and add as many possible things together to the trade for it to logically make sense for the trade to actually go in one direction versus the other. Because we all know the market is going to do two things. The market from this point right here can either go down or it can continue to go up, right? If you at any point in your life, you figure out if the market does either one of those two things, you fucking call me, right? Because you're onto something special, or there's something wrong with the market. But in my humble 7 years of trading in these markets, I have never seen the market do anything other than from this point right here, go up or go down. So it's already a 50-50 chance. But now what if I told you that if at this area right here, there is 7 reasons on why it has a higher probability of going up than going down? Well, it just simply makes more sense to buy it than to sell it. That's really it. At no point in my trading am I 100% confident that this trade is going to go in one direction or the other. I just simply have so many reasons for it to go in that direction versus the other that I go ahead and risk money behind it. But I don't have inside information. I don't predict the future. I don't have a crystal ball. I am not an alien, right? I just have a logical amount of reasons on why it's going to go up rather than down. And that is all based off of everything that I've taught you on this video. First thing, for example, is this market bullish or bearish? All right, cool. Well, this market is bullish. All right, cool. So that's the first thing we got, right? We already understand the market is bullish. Cool. Well, where's the market right now? Well, this market is at an area of interest. That is a respected area of interest. Shit. All right, cool. So we are at an area of interest. So this area of interest is obviously a very well respected support and resistance. We're above it. It could be used as support. Okay, cool. So right now we understand we have 2 of these confluences in our favor. All right, cool. What else do we have? So we also have at this area, let's say this is the daily time frame or the 4-hour time frame, has created a doji candlestick, an undecision candlestick. And after this undecision candlestick, it's created a morning star formation. Wow. We have a morning star formation, for example, morning star formation. We have 3 logical reasons on why this trade should go up or should go down. Now, this is a simple, very simple confluence trading checklist that I just built off of 5 seconds. We understand that we are having very clear indications that this should continue to go to the upside rather than the downside. We're at a support level, we're trading with the trend, and then we have our entry signal. Go ahead, we enter our trade, and after we enter our trade, guess what? The trade does what it does. Continue trading with the trend, has a reaction from a support level, and it has the momentum based off of the entry signal confirmation. That right there is literally confluence trading. Now, that's me not even including if we have the EMA, me not including if maybe on the 4-hour time frame there's an inverted head and shoulders over here. That's me not including so many other little extra things that can be added to this for it to make more sense, right? This is just me going off of 3 basic core foundations: trend, area of interest, and entry signal. It simply makes more logical sense to enter this trade on a buy rather than a sell. And the best way that I can present this confluence trading is if you literally go up to your parents, your siblings, your cousins, your friends, somebody that doesn't believe in your trading journey or somebody that doesn't even understand your trading journey, and you literally tell them, all right, you show them this chart, for example, right? So let's say, for example, I'm going to show you, let's say, for example, this market right here, right? For example, let's say this market right here, and you go ahead and tell them, all right, what do you think this market is going to do? Do you think this market is going to go up, or do you think this market is going to go down? They're going to have no, right? Because you're going to show them an empty chart like this. They're going to be like, dude, I have no idea, up or down. Now, they might be right or they might be wrong. It's really a 50-50. It's not that hard to be right. It's just very hard to be right consistently. and profitably. And that is where having just a proper checklist and a proper confluence list that changes all of that, right? So let's say you just tell your random family member, your random friend, or whoever, if this is going to go up or down, and they just say, okay, I think it's going to go up, or I think it's going to go down. And you tell them, okay, let me tell you what I think. And then you start explaining to them, all right, well, this market structure is currently bearish. So this is the lower high. This right here is the lower low. Secondly, after this market being bearish, this right here is a respected area of interest. And we also happen to be very near the neckline of this head and shoulders, which is a massive reversal pattern. To add to that, when we go down to the 4 hour, the 4 hour is rejecting this 4 hour EMA. And when we go down to the 1 hour, we're having a 1 hour pin bar rejection from this area. They're going to look at you like if you're a fucking mad scientist, and they're going to be like, well, you're talking Chinese, but you know what? These are many things that I don't know what they mean. And I guess it makes more sense to sell than to buy at this point. Just for example, right? Just me right here, I pieced up a trade to make more sense to sell than to buy. That is all confluence trading is you get everything that I have been teaching you, which is just very over the top. And by the way, these are more things that I can teach you later on, but these are just very over the top things that make the trade make more sense, right? A better example could be this trade, for example, right here that I was interested in taking and I happened to miss out. Or even this trade, for example, that I was interested in taking. We have the trend, the lower time frame trend in our favor. We break this area, we come back to retest the neckline. We are retesting the neckline of the area of interest. We have had a shift of structure. We are rejecting the area of interest. We are rejecting the EMA, and then we have a massive bearish engulfing candlestick. It just makes more sense to sell than to buy. Confluence trading is literally building the perfect trade setup for you to have the most amount of confluences in one direction or the other. Now, I get this asked all the time. Is there a minimum amount of confluences that I would have in order to take a trade? And the answer is no. Why would I want to have a minimum amount of confluences? Like, that just makes no sense to me. If I want to risk my money, where my money is going to be the safest. I don't know why traders have this perception of high risk, high reward, right? Or people that just get involved in trading, they think, oh, whatever's high risk is high reward. Guys, we are not in the casino. We are not in the, what's that thing that the Powerball? We're not in the Powerball. We're not in the Lotto. We don't want high risk. High risk actually means low reward. A trade that has zero confluences is high risk. And if it has high risk and no confluences, the odds of you winning that are very low, right? So you're not going to have a very high return on that. But now if a trade has 8 confluences, for example, that makes that a very low risk trade, and meaning it's a very small chance that you're going to lose. So it makes more sense to risk more money on that. And that is where you in turn have higher reward. You have high rewards on the low risk trades. Why? Because you're going to risk more money on trades that have less odds of losing. You're not going to risk more money on a trade that has higher odds of losing. If it has higher odds than losing, I don't even want to get involved. I want to get involved when I have the least amount of chances of possibly losing. And that is exactly what confluence trading is. You're building a approach to a trade where it simply makes more sense to do one thing rather than the other. Perfect example is right here. This trade right here, we were rejecting this very strong area of interest. The daily time frame was bearish. This was a massive bearish engulfing pin bar rejection. I then go down to the 4-hour time frame. We have a left head and a right shoulder. We break this neckline. I go down to the 1 hour. On the 1 hour, we then have another left head, right shoulder. On the right shoulder of the head and shoulders on the 4 hour, we break this neckline. We come back, we retest, we reject the EMA, and a massive 1 hour bearish engulfing candlestick. I have just told you 7 different confluences in 5 seconds off of everything that I've just simply told you. Daily rejecting area of interest, daily bearish engulfing candlestick, 4 hour head and shoulders candlesticks. Then you also have a break and retest of that head and shoulders neckline. That's another confluence. And then on top of that, you have a head and shoulders on the 1 hour time frame, break and retesting that neckline, rejecting the EMA, and then your entry signal, which is the bearish engulfing candlestick on the 1 hour. What else do you need for it to make more sense to buy? Now, don't get me wrong. There's going to be times where you're going to have 10 confluences make sense on your trade. And then guess what's going to happen? The trade will go in the opposite direction. There's no guarantee at any given point that the trade is going to always win. No, but it just makes more logical sense. That's why I tell people all the time, I think trading is the ultimate hack to making money online, because I just think you can literally predict the future by just having the most amount of reasons on why it's going to go in one direction versus the other. The best analogy that I can put with that, it's almost like if you're going to go out there and go fishing, right? And let's say you're going to go out there and go fishing, and you know, historically, when the waters are calm, when there is a very bright sunny day, no clouds, and you're the only person out there fishing, and the tide is low, for example, I'm not a fisherman, right? I'm just making stuff up right now. And the tide is low, that the fish have nothing else to do but eat, and they're going to be looking for food. What if I told you that you can literally just sit by the dock and wait for the weather conditions to give you that perfect condition, and then you go out and fish at those times? Why are you going to go out and fish when it's cloudy, when there's 100 other boats out there, and when it's late at night or late in the afternoon when there's already been a feast? You won't do it. It simply doesn't make sense. You're going to go out there when it makes sense, when you have all the proper conditions for you to go out there and actually go and fish. This right here is you literally creating your condition. You're just sitting on the sideline, sitting here on the desk, and you're going to wait for the market to give you that perfect entry signal for you to enter the trade. You're not going to just enter any trade impulsively just because you have the opportunity to do that. Yes, can you just get on your boat at whatever point you want and go out there and fish? Yes, you could do that, but you're going to waste fuel. You're going to waste time, waste bait, and then most importantly, waste your own mental sanity because you just want to go fish whenever you want. And can you get lucky and catch 1 or 2 fish? Sure. But that's not how you're going to sustainably catch a shit ton of fish and make your family happy and bring food to the house. You're going to do that when you go do it at the effective times where you're going to be able to optimize and grow the most and be able to actually do it the most. And that's exactly what confluence trading is. You're building the most amount of reasons on why the trade should go in one direction versus the other. And it's all a checklist, right? So for example, you can build your own custom checklist. You can build a checklist, for example, just off of the confluences that I have told you. The first one could be trend. The second one could be area of interest. The third one could be entry. And then lastly, you can have patterns, right? So when you go analyze a trade, you say, okay, we have the weekly and then the daily in our favor. All right, cool. That right there, we have a double check. We have 2 trends in our favor, right? So we have the weekly and the daily in our favor. Are we at a weekly or at a daily area of interest? Well, right now we're in neither. Okay, so you don't take a trade if you're not at the area of interest. You simply wait. Okay, cool. Now we're at the area of interest. Bet. We check that off the list. Now that we're at the area of interest, do we just jump right into the trade? No. You need your entry signal, or you could jump into the trade right if you want to. But the beauty of the entry checklist and the trading plan is that you know exactly the type of trade that you are taking. You're aware of the decisions that you're making. You're not blind to it anymore. You know that you need these 4 confirmations for you to take the trade. Now I have my own custom